focused on is that the growth recovery that we are seeing on the ground from a number of different sectors looks extremely healthy and compelling to us. The final point I would make is we can't forget that India is responsible for significant manufacturing of vaccines, and I think that's going to work very much in their favor over the course of the next 6 to 24 months.
Very good. Eric Robertson, thank you so much. With Standard Chartered, their global head of research. The most important letter of an annual report, and let me make clear, annual report letters are essentially useless from most CEOs, was the late Robert Williams of M&T Bank in Buffalo, New York. Everybody in the financial world read every year, every word that Williams said. James Dimon of J.P. Morgan has extended the Williams purview to something new and original. It is a 66-page letter released moments ago by his J.P. Morgan, and it is extraordinary. It is essentially a brief that could be made for Secretary Yellen, a brief that could be made for the president, and most, dear fellow shareholders, a brief in the heat of this pandemic for his J.P. Morgan shareholders. I want to bring up one board right now. I dived into this about an hour ago, and I want to bring up one board here which just touches upon the emotion, Lisa, that we see here. And it's very simply, not on the, we'll do the curiosity later and some of the, he talks about Zoom, and we'll do that later. But I want to, Brad, do we have that board up yet? Let's get that up right now. And the board is real simple. It is about how you manage in a pandemic and how you move on from a pandemic. The problem with the American public's impression of shareholder value is that too many people interpret it to mean short-term, rapacious profit-taking. And then he goes on, good morning, Ken Langone, where I got my vaccine at NYU. I have always loved that Home Depot's company policy is not to raise lumber prices in the immediate aftermath of a hurricane. Lisa Bramwitz, this is not a normal annual report letter, is it?
No, it's basically a public relations job, first of all, to say, look, we are really well capitalized and we have a duty to the economy and to our society way beyond just profits for our shareholders. They also laid out basically their entire agenda, really pushing forward to the new economy of fintech, of also this idea of cybersecurity and talking about the new reality and how big tech companies are their big competitors going forward and should be regulated as such as they try to plow into the banking world. To me, this letter screamed of trying to create a public reputation and impression post-pandemic of the banks being stalwarts of society, not the opposite as they were in the previous crisis.
And within the stalwarts of society is in the beginning of the letter a real effort to look more long-term rather than short-term, as we just discussed. Here's another set of quotes buried in the letter, and this is where Mr. Dimon really begins to get going on what he's learned about the pandemic. Bring up that board again on curiosity. I think this is very important. He sets out some ideas here. As companies get bigger and more complex, leaders need to be more like coaches and conductors and players. Have curiosity. Good morning, Matt Winkler of Bloomberg News, who loves that word. Leaders should be happy when their people prove them wrong. Skip hierarchy. I do that every day with Sonali Basak. Collaboration is wonderful, but it can be overdone. Come on.
I know. This is
just
for you.
Too much MBA speak. Act at the speed of relevance. I have no idea what that means, James. I've also seen people take a tremendous amount of time to make an unimportant decision. We made an important decision to bring in Sonali Basak here on. Sonali, what I love about it is not only is it a 66-page speech by Dimon on his view of the world, but there's a lot of fancy charts showing a bank that's a bank leader.
Oh, absolutely. And it goes all the way back to Bank One, right? It's since 2004, how much J.P. Morgan has grown since then, and the impact of regulation, right? We've heard Jamie Dimon talk about that before, the constraints that it creates, but also the opportunities as the banks were safe during this crisis.
What did he say about the view forward of what they can do? Now, to be clear, they can't go out and buy another bank. They're so big that they can't go out and buy a super regional or regional, right?
They're not allowed to buy a regional or a super regional.
So what's his future?
They could buy a fintech, right? He cites very clear competitive threats from the financial technology industry.
I need to make some news here. It's a slow day. Is he going to buy Twitter?
Oh, seriously, Tom?
If you consider Twitter a fintech, right? These days, you can consider Clubhouse a fintech sometimes if you want to.
Are you in Clubhouse?
I am am on
Lisa,
Clubhouse.
are you
love
on
this.
Clubhouse?
No, I'm not
We
in
are so
Clubhouse,
behind the
despite the fact.
times.
Oh yeah, are
We
you
are
in
just-
Clubhouse?
Lisa, pick it
Yeah,
up here
he's
with
like,
Ms.
I don't want to
Bassett.
talk about it. Shanali, there is a question of what the motivation of Jamie Dimon is. In the past, there have been questions about his political ambitions. This letter was political in its nature and how it was trying to give off a certain impression. Is this just a public relations job for the bank, or does this go beyond that?
So, Lisa, I missed your question there. Sorry about that. However, I will tell you something else I saw in the letter that I thought was quite interesting. The competitive threats are interesting, but, we really watched Jamie Dimon's letter for tonality. And this year especially, we heard from Warren Buffett, and his letter was really criticized as tone deaf. Usually the letters play off of each other. What did we hear about tone? Optimism, right? We've heard concerns from Jamie Dimon before about different things in the economy, in governments, and we still hear some of those concerns about healthcare, about the mortgage system, all sorts of things. But optimism. He really does have optimism about the economy booming, he writes, into 2023.
Shanali, he reaffirms that they're going to build the palace on Park Avenue and that they're going to build offices. But boy, does he have some comments on the Zoom world. It's a standard joke here at Surveillance, folks. I've never been on Zoom, and trust me, I feel privileged that I've never been on Zoom. Here's Mr. Dimon talking about what he and his team have learned about all this modern office architecture of the digital world. Most professionals learn their job through an apprenticeship model, which is almost impossible to replicate in the Zoom world over time. This drawback could dramatically undermine character and culture. Remote work virtually eliminates spontaneous learning and creativity, where Shanali Bassett runs into Tom Keene at the coffee machine and says, "You were wrong on the show today." I mean, it's about the coffee machine, isn't it?
It's absolutely about the coffee machine. He says Zoom eliminates that follow-up. He's pretty specific, Tom. He says maybe 10% of people could be permanently working from home, but most people who are working in bank branches and many others, will probably be coming to work permanently. So you're right, he is keeping that real estate.
In the meantime, Shanali, there's also a question about the political tone, and this is what I was going to before our technical difficulties. The political ambitions, both of Jamie Dimon, as well as the role of corporate CEOs in a more political way. He was talking about dysfunction, about how that has crimped growth, about how important it is for people to get it together. What is the goal of this? Is it that Jamie Dimon wants to run for president?
It's a great question because, prior to that question, there was perennial rumors about Jamie Dimon, the Treasury Secretary, right? Every cycle we get that rumor. But, the thing is, a lot of people this year, and what we hear from executives is a frustration with government, the shortcomings, and where businesses need to step up and step in. And, he really leads off the letter that way, the role of a corporation, right?
Yeah.
Can you do more from where you are?
Right. I'm going to, Shanali, one final question here as you dive into 66 pages this morning. And again, folks, I really want to emphasize this letter is to be read by everyone on Global Wall Street. Is really a mandate for MBA CFAs to really try to figure out best practices or the worst practices to avoid. That's where I want to go. What's his worst practice? And from a financial standpoint, what's the thing he wants to avoid?
Taking on too much risk, perhaps? I was shocked at how much there was about regulation.
I agree, yes.
One of the key issues.
It's boring, but yes, you're absolutely right.
One of four things he says is a key issue is the new accounting rules for JP Morgan and the fact that they are holding to their standards despite what the government says they should be doing.
Tom, you really can sell it.
Yeah,
it's really boring, but, I guess we got to get it in.
Regulation, I mean, it's like watching paint dry, and he goes there for 5 of the 66 pages, but Shanali's right. He's looking at the financial aspects, the behavioral aspects, and the regulatory aspects of banking for Shanali Bassett, our chief Wall Street correspondent. She'll be memorizing those 66 pages as we waltz through the morning. Right now, we waltz to Washington and to our Emily Wilkins, Bloomberg Government's lead reporter. There, Emily, Washington has to deal with a corporate elite like James Dimon. How is the corporate elite doing with a Democratic majority?
Well, so far they seem to be in a bit of a better place with Democrats than necessarily Republicans. I mean, we're currently seeing a lot of uproar in DC and elsewhere among Republicans, sort of criticizing the decision of the MLB to move their game out of Georgia, as well as other corporations like Delta and Coca-Cola who have criticized Georgia's voting laws. So a bit of a bump there. But I mean, let's be honest, corporate donations are still a thing. Lawmakers still need money to make sure that they're going to run again in 2022 and be able to win. So the relationship between corporations and lawmakers is still very much there, even given some of the recent back and forth in the news.
Lawmakers need campaign donations from these corporate executives. They also need money to pay for some of their ambitious plans, whether it's infrastructure or some of the other initiatives that have been proposed in Washington, D.C. Yesterday, Jeff Bezos of Amazon coming out and saying that he backed Joe Biden's proposed tax hike if it went to pay for some of this infrastructure work. How is this being received on Capitol Hill, given the fact that Amazon has paid a very low tax rate for a long time?
Absolutely. I mean, I think you've seen a couple different opinions from lawmakers at this point about what they need the tax rate to be. I think Bezos' statement yesterday, definitely spoke in favor of Biden's plan to raise the corporate tax rate. He wants to raise it to 28%. But you've already heard from Senator Joe Manchin, who's a very key Senate Democrat vote, that he does not want to see the corporate tax rate go that high. And I think it's going to be interesting to sort of watch President Biden over the next several days and weeks as he really tries to sell the infrastructure plan, both to the American people, but also to businesses and corporations and other groups like Amazon, try and get them on board and hope that they can sort of put pressure on Republican lawmakers to consider backing parts of Biden's plan.
Emily, is this just basically like two 4-year-olds in a hallway of nursery school with their foreheads pressed against each other saying it's one way, no, it's the other way? Or are they bringing real evidence to the table of what tax hikes would potentially do, how it could potentially affect growth? Are we looking at real statistics and empirical evidence, or is this just basically a battle of faith?
I mean, it's not like President Biden is pulling these numbers out of the air as he stands at the podium telling people what his plan is. And I think behind a lot of the scenes, yes, you are seeing those negotiations. Can we live at this rate? Well, what happens if we do this rate? I mean, this is all sort of the details of the sausage getting made a little bit here. And remember, we are still at the very beginning of these negotiations around this bill. Heck, Congress hasn't even been in Washington for the last 2 weeks. They've been back in their districts. So rubber's going to really meet the road next week when they get back and we start to see these bills go through the committee process.
Emily, what have they learned in their districts? Always illuminating, always different. There's always a little bit of a twist. What are they learning on the sojourn home?
Well, for a lot of them, it seems like a lot of them are hearing to a certain extent what they want to hear. Democrats are at home. They're pitching that $1.9 trillion stimulus that just passed. But we've also seen reporting from Republicans who have said that their constituents, they're worried about the amount of federal spending. It doesn't really seem like this last trip back home is going to make any sort of we're not going to see any big 180 in how either of the parties have been approaching these larger spending bills.
Emily Wilkins, thank you so much. Really can't say enough about it here as we begin an eventful day in Washington and certainly drive forward to the World Bank and IMF spring meetings. Lisa, your thought on 66 pages. I know you're going to read every word.
Yeah, well, my main thought is that, first of all, it seems like JP Morgan is interested in acquiring a fintech company. That's first and foremost. How will this be used? Is this going to be like a Marcus arm from Goldman Sachs where they cater to the consumer? Is it going to be something more B2B? How are we going to see this play out? Also, this idea of threats from every angle. This is a Jamie Dimon that does not want to grow complacent as it faces basically a shrinking pool of potential competitors since they are the behemoth, indisputably. This is a JP Morgan that wants to give the fire to their employees to say, we need to stay good and we need to get better.
Last year, I believe it may have been the year before, he really emphasized, look, all this is hard work, is that you wake up every morning and you go do it on a global platform. And I didn't hear that this year. What I heard much more was a global reach, Lisa, a truly global reach about what they're going to do forward, given all of those threats, those competitive threats were the lead of the letter.
Yeah, competitive threats and cybersecurity threats, both having to do with the cyber realm. To me, this is also the banking industry waking up to a very new reality that was accelerated, brought forward by the pandemic, of a cyber world, right? What does that mean for banking? What does that mean for the frictions that have actually given profits to a lot of the banks that are being removed by certain new technologies? These are all things, whether it has to do with Bitcoin or crypto assets, or whether it has to do with some mobile technologies. What does this mean for the big banks? And that is clearly on Jamie Dimon's mind.
I mean, just going through and looking randomly here at many of the thoughts partitioned out into numbered ideas. Before conducting an important analysis, assess all relevant factors. And he leads with China. In the analysis that JP Morgan is doing, Mr. Dimon, I attempt to analyze China as a strategic competitor. It's critical to weigh all the factors, cultural, psychological, and historical. We'll have much more on Mr. Dimon's thoughts on global banking and, frankly, on his nation of America as well through the morning. Again, I really want to emphasize this day of the World Bank and the IMF. At 11:30, I'll speak with Georgieva of the IMF. Futures, what a shock. They advance. Where are we? We're getting near Dow 34,000. Dow 5,000's out there. We have the right guest, Robert Albertson of Piper Sandler, joining us here on the future of American banking, the future of JP Morgan. Stay with us. This is Bloomberg.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy and we need companies to step up.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Bloomberg Surveillance, Jonathan Farrell, Lisa Bramwitz, and Tom Keene. Mr. Farrell off. He returns at some point. I'm not sure when.
Tomorrow.
Check with HR. Lisa Bramwitz and me this morning in a busy day. Equities up, IMF World Bank meetings. Mr. Diamond out with a 66-page jewel. You need a data check away from the equity market. Here's Kaylee Lines.
Well, Tom, it is relatively quiet out there. We have equities around the world right around record highs. Of course, the Stock 600 in Europe is just off those levels today. And with futures, we are pointing to a higher open, but only by about 3 points on S&P E-minis. Where my attention really is on the bond market, because we continue to see yields moving lower. Maybe that bond sell-off was just a bit overdone. The 5-year yield has moved down 12 basis points in just the last 3 days. Of course, the belly of the curve likely will react to whatever we get out of the Fed with those minutes come 2 p.m. Eastern time. In foreign exchange, the dollar is mixed in the G10 space. It is weaker, though, against the euro dollar sitting right now at 118.89. And in the commodity complex, my eye is on oil. WTI crude has been fluctuating between gains and losses all morning. Right now, it is in the green by about 0.9%. Still, though, below $60 a barrel. The market is continuing to weigh that supply and demand picture, and we'll be watching inventories data at 10:30 a.m. Eastern time here in the U.S. to see what kind of catalyst that could be, Tom.
Kaylee, thanks so much. We planned on doing this, and we didn't understand that it would be a 66-page letter by Mr. Diamond. Certainly a tour de force, but you need the right guest at the right time, and that can always be Robert Albertson on banking with Piper Sandler. His leadership at Goldman Sachs decades ago in bank research out of Carnegie Mellon and Harvard. We're honored that Robert Albertson could join us this morning. Robert Albertson, you and I used to look at MD&A, and it was a good way to fall asleep. Where did we go from Robert Willens of M&T Bank to a 66-page missive from James Diamond? How did we get to these long letters?
I think it's a personality, partly. He is a very analytical person, and yet he has a way with words, and he recognizes analysis for its limits and the possibility of analysis paralysis, if I would suggest it. But he is attuned to so many different things and has pretty reasonable comments about all of them.
Within the comments you mentioned to us before this conversation, you were zeroing in on his view back to the 1970s. Why is now for James Diamond like the 1970s?
Well, it's sort of unlike the 1970s. He's basically saying we had a recovery out of the 70s. Recessions without quantitative easing, and we've had quantitative easing this time around, and it hasn't done much. So I think he's pointed to the awash with liquidity mistake in terms of monetary policy.
There also is a question here of what his political ambitions are, given the tone of this letter. He is talking about dysfunction. He said Americans know that something has gone terribly wrong, and they blame this country's leadership, the elite, the powerful, the decision makers. This is completely appropriate for who else to blame. A lot of people have looked to the financial sector. Is this just a defense of the banking industry, or is this something more, an engagement that goes beyond just from the C-suite into government?
I think you have two ways to look at it. First of all, I would not be surprised to see him turn up somewhere in government in a high role, and I think he would be excellent at it. The second point is he is from banking, which has been the most criticized sector I can think of. And we have just gone through the most shocking recession in memory, and the banking industry has shown no credit problems. It is remarkable that the underwriting of this business has gotten to where it is and the risk control. So he's proven something in a very tough area. I think he'd like to prove it in a more public policy way.
He also talked about his fortress balance sheet, to your point, about how it emerged very much as a stalwart during this pandemic. There's a question also of what's next, and he made a big point about fintech, how that is the big competitor going forward. And he actually talked about potential acquisitions in that space. What kind of tie-up could you see with JP Morgan? What kind of fintech company?
Well, frankly, it's a little hard to come up with that because they have their own budget and their own fintech operation, which is pretty powerful. They're also a complex organization, and a lot of what's out there with fintech isn't really appropriate for a JP Morgan. Having said that, I think he's very focused on what it can do in retail banking, number one, and I think that's kind of obvious to all of us. But also number two, in terms of what can be done with artificial intelligence.
Mr. Diamond making clear he's not a fan of Zoom meetings, as Robert Albertson is not a fan of Zoom meetings. Robert Albertson, let's go there right now as Mr. Diamond talks about fortitude. This is a scathing statement, folks, on leadership. It goes on for 2 pages. Fortitude. This attribute often is missing in leaders. They need to have a fierce resolve to act. It means driving change, fighting bureaucracy and politics, and taking ownership and responsibility. Mr. Diamond goes on to say, ability to face facts in a cold-blooded, honest way. Leaders emphasize the negatives at management meetings and focus on what can be improved. That, Robert Albertson, sounds like best practices for every leadership out there right now. How do you move forward with that negative statement? How do you go into a bank management meeting with negative analysis to come to a positive outcome?
It's a good question. I think the real answer is embedded in what he's done and what he's achieved and why he's achieved it. And if you look at the importance of analysis and facts in almost any industry, they are critically important. We all know that. They seem to be absolutely devoid in the political sector, taking positions, making arguments that are financially wrong. You almost need a cop out there to control what the politicians are allowed to say.
Robert Albertson, a 2-part question. How does banking respond to James Dimon? How does American banking respond to this juggernaut? And very importantly, how does European banking respond to James Dimon?
I'm not sure the European banking system will ever respond to the American banking system's successes. They seem to be mired in their own history and legacy, and they don't seem to be able to get out of it. But having said that, in terms of the U.S. banking system, I think most people look up to him. They know they're not him in terms of their vehicle, but they recognize what he says is critical. And if you want to talk about being a good corporate citizen, all you have to do is go into some small community bank and see what they're really doing in that market that is community oriented, to recognize they're pretty much singing the same songs he is in terms of giving back.
There's a question of whether banks are going to take more risk right now, given their fortress balance sheets and given the robust economic outlook, or whether they'll pare it back to avoid getting ahead of the economic cycle. And this really seems to be a tension beneath Jamie Dimon's letter as well, because he talks about the dynamism of the economy, the economic boom possibly lasting till the end of 2023 with all the spending in QE, but also talking about pockets of froth that he didn't specify. Can you talk about how banks are handling this? How high is the pressure to push further into risk to get returns at a time of economic dynamism?
Not as high as you would think. They are very proud of coming out of what we went through in one piece, and I don't think they wanted to spoil that. I don't think underwriting standards are going to change. They are starved for loan growth. The key here is if we have an infrastructure package, that plus the last bill, we have enough trillions in the economy to drive a huge capital expenditure cycle, investment cycle. Everything so far has been on the consumer side, and the stimulus that's been aimed at that. Now we're shifting it to the commercial side. That has great power. That could really make 2023 even better year than 2022. Most people don't look that far and see that yet. But if we get this infrastructure package, it's right up Jamie's alley of fiscal spending. It could really knock the cover off the ball. It could drive our economy into the 8 or 9% range. It could drive rates up for sure, and inflation, all understood and accepted.
Can you talk about where rates would have to go to make this as lucrative as you expect for banks? Because this is something Jamie Dimon's been very clear about. He sees benchmark 10-year Treasury yields going a lot higher. He's been wrong year after year. What's your view in terms of how high they have to go to make this equation make sense?
Well, I'm wrong with him and have been wrong for years. The history of the long-term interest rate cycle is that it averages about what nominal GDP growth is. And if we got 6 or 7% GDP growth and 2 or 3% inflation, you come up with a crazy number for the 10-year. I would argue that it's going to get to at least the 3% level in fairly short order. The banks really care more about what happens to the short end of the spectrum. They need the Fed funds rate to get moving and not stay at zero. And I think that's actually going to occur this year, not next year. A lot of people think it won't happen. Yeah. And I don't blame him, because that's what the chairman of the Fed keeps saying.
Robert Albertson, thank you so much. Good health to you, with Piper Sandler, of course, on this day of Mr. Diamond's letter. Wonderful to get decades of perspective from Mr. Albertson. Lisa, you know, I look at where we are with this letter, and I really want to go back to the global sense of it. We can make a lot about, you know, the Zoom discussion and the leadership discussion, and it's all great for TV and radio. But I was really amazed, I should say, about the China comments, and particularly the global competition comments.
You know, going to the China point, that's exactly where I was going to head. This idea of the toggle of corporate executives, particularly in the finance world. China is an area of growth. They have been wanting to get into China. They have been getting into China. How do they do this delicate dance with the diplomacy of the United States that's turning into this very U.S. versus China dynamic and accelerating on that, while also pursuing the economic opportunities in a country very much dominated by authoritarian government? This is a difficult dance. How do they message this correctly? Right. And you could feel that in this letter.
Well, it's a difficult dance there. And, you know, Albertson didn't want to go to Europe. I mean, you know, you think about the conversation we had with David Harrow on Credit Suisse the other day, but you just wonder how the American banks approach a troubled bank like Credit Suisse, a troubled bank like Deutsche Bank, but frankly, Lisa, how they approach the stronger banks of the United Kingdom and Europe.
Are you trying to spread a rumor today
I'm working on it.
Sort of
you know,
tie-up?
I know that Mr. Diamond's team is watching.
You're doing hard. You're doing it hard.
You know,
JP Morgan and Twitter.
I think
JP Morgan and Credit Suisse.
I think Mr. Diamond looks really good at Bar Leap there, Brasserie Leap, I should say, in Zurich. I think
it is highly unlikely, from all the banking executives and analysts that I've spoken to, that a big U.S. bank like JP Morgan would acquire a European bank, and I don't know that they'd even be interested in that. Yes, carry on.
Joe's calling from JP Morgan right now. I wonder.
Well, let's hear it. What does he have to say?
I wonder who that could be. Anyways, it's fun, folks. And again, I really want to say to all of you on the academic track, it is truly valuable 66-page must read. Lisa Bramitz and Tom Keene with John Farrow. Thank you, Riley. With John Farrow, the data here, futures up 3, Dow futures up 20, the VIX 17.87. Stay with us on the pandemic. Lauren Sauer next. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Joe Biden is ramping up pressure on Republicans to support his $2.2 trillion infrastructure plan. He's appealing directly to GOP voters whilst lawmakers are in their home districts. Today at the White House, the president will make his second major sales pitch for the plan in a week. He's facing opposition from conservatives and business groups who are against proposed tax hikes. The U.S. says it will consult with allies about how to handle the 2022 Winter Olympics in Beijing. That sparked discussion of a possible boycott over China's human rights record. Last year, more than 160 human rights groups urged the International Olympic Committee to hold the Beijing Games elsewhere. The U.S. government will not issue so-called vaccine passports. The White House says there will be no federal vaccinations database and no mandate that everyone obtain a credential. Some businesses and colleges are pushing for people to show proof of vaccinations. France's finance minister wants to know what happened with the European Union's recovery fund. He discussed the slow rollout of the fund in an exclusive interview with Bloomberg TV.
But the point which is not on the right track is the European recovery plan. We have not seen one single penny among the 750 billion euros that have been decided last summer in 2020. I'm deeply concerned by the delay in the implementation of the European recovery plan. That's the key point.
Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
There's a lot of good news, but there's also some bad news. New variants of the virus are spreading, and they're moving quickly. Cases are going back up. Hospitalizations are no longer declining. While deaths are still down, way down from January, they're going up in some places.
The President of the United States with a daily update there, if you will, on the virus. Loads of good news, some challenging news in America. Certainly the shock for the medical community, as we heard yesterday from our guest, over 38,000 people in a baseball park in Texas. But we move forward, and we move forward in America, all in all, with the arched question of which vaccine to get, and maybe also looking at this debate of vaccine passports. Lauren Sauer joins from Johns Hopkins, their assistant professor of emergency medicine. Lauren, from what you study and with all your contacts at Johns Hopkins, are we out X number of months where so-and-so can't get on an airplane because they don't have an identification or proof of vaccination?
I think it's going to depend on what airplane they're trying to get on. So part of the challenge with these vaccination passports or with the proof of vaccine is that they're being rolled out all across the board in different ways. And that's one of the biggest challenges is we don't have a national or global strategy on how we communicate about these vaccines. I think in a lot of places you'll see just that, vaccine requirements, even before vaccines maybe are moved from emergency use authorization to approval. So what that rollout looks like could be totally dependent on where you are and who's asking.
Where do you, this came up a number of times yesterday, it is, let's call it middle of April. Where do you perceive will be middle of June?
I think here in the US, we're going to have many people vaccinated, and it's going to look like a different summer than it certainly did last year. I think we're seeing reopenings happening across the country. My concern really is that we need to hold on to these social distancing practices, the masking practices a bit longer as we see how the vaccines do against the variants, and we see how the summer looks after some of these states have already started their reopening strategies. I'm hopeful that we'll have a summer that is much more looking like a normal summer than we did last year.
I'm trying to get my hands around the actual data, what you said about the efficacy of the vaccines against some of the variants. I was reading some data saying that they were actually very effective, certainly the B117 variant as well as the South African one. Are you seeing different information?
No, I think that's right. I think everyone is hopeful that the vaccine data will hold up. We're just early in the process, and the variants are at really different levels depending on where you are in spreading in the community. And so we're waiting to see what the studies come out from the vaccine makers, because they're all working on this right now. But we're also seeing just the preliminary data from people who are vaccinated in the community. And so I think the hope is exactly what you're describing, is that those numbers maintain and the vaccines are still incredibly effective. Possibly we'll need boosters for some of them, depending on what happens with the variant spread, and possibly they'll work as is.
Yesterday, we were talking about an internal memo that was being circulated in the European Union, talking about how they were hoping member states, member nations would have enough vaccine to inoculate all adults by the end of June. This vaccine is AstraZeneca. What is the problem here with AstraZeneca and getting the confidence that it's necessary to get people to actually take it?
I think one of the big problems, honestly, has been the communication, and that's the communication from the company to the regulatory bodies and the communication about the findings. And so, we're hearing all these stories about weak data or about the varying levels of efficacy, but in the end, this is still a highly effective vaccine that has the potential to be readily accessible across the globe. And so there is this group that may be affected by the rare clotting outcomes that we've seen, particularly this younger population. I believe it's more affecting females. But that being said, for the rest of the especially vulnerable elder communities, this is still an incredibly safe and effective vaccine. I think everyone wants to see the final data set that's going to the regulatory bodies, and not just interim trial data or pooled data. And that's the key piece.
Lauren, everyone's talking about this, and I'm not going to mention any names on here, totally inappropriate for us as an amateur to do this, but does the public decide which vaccine they want? Are we to a point where, like all the drug advertising in America, unique to America, that somebody walks in and says, no, it's either this one or I'm not having it?
I think eventually we will be to a point where people can decide. Right now, we're not there. We're at a place where if vaccine is available, you get that vaccine. And that is the important thing is that the vaccine is available, and that all of the vaccines that we have coming down the pipe are incredibly effective. And I think that for a lot of us, that was a place we weren't even sure we were going to be at this point in time. So it's exciting to see that we have multiple options, especially we even have 1 and 2 dose options. And those 1 dose options can be great for reaching hard to reach populations. The key will be as we move away from this emergency phase and into sort of maintenance of protection, the way we do with flu and yellow fever and other required or readily available vaccines, that we understand the value proposition of these different type of vaccines, and we continue to investigate their ongoing efficacy and their ongoing safety beyond just this emergency phase.
How much do we know how much these vaccines prevent infection, not only prevent the illness itself or getting very ill, and how quickly do we know that they actually work? Do we have that data?
We have the data on how quickly they work to prevent severe disease and keeping people out of the hospital, which is the most important thing right now in this emergency. The data continue to roll in on how protective they are against transmission. I think we saw data recently from Pfizer that shows that it is highly effective against transmission. And so as we move into more and more people in the population getting vaccinated and still having exposure or contact with people who may have the disease, we'll start to see more data on whether or not these vaccines are across the board preventing transmission or if they're just preventing people from getting sick. But either way, they're keeping people out of the hospital, and that is huge right now.
Lauren Saar, thank you so much. Greatly appreciate it. With Johns Hopkins, their assistant professor of emergency medicine. Lisa, in the bond market, what do you see besides yields have come in? I mean, it's sort of mid-tendency, isn't it?
Well, yields are coming down, which is interesting given the fact that last week we were talking about how yields were heading to 3% without stopping. And all of a sudden we've got that bid back. The interesting thing is it's coming amid optimism, right? It's not necessarily bad news that the bond market is seeing that's affecting equity valuations. And certainly it's not seeing credit continuing to tighten with yields going to new post-crisis lows, at least on these spreads. Yeah, I did.
Hanging out with me way too much. Pretty soon
Cheers.
They'll just laugh. I know. No celery. That trick is no celery.
Thanks.
Real yield, negative 0.67, and we've seen this a little bit, this linkage here with a nominal in the real yield. 10-year yield, 1.65%. On the equity markets, Amy with Silverman, really must watch right now. RBC Capital Markets, futures up fractionally. This is Bloomberg on radio, on television.
know that Norway sells way more electric cars per capita than the U.S.? Norway. Well, I won't stand for it.
In this neighborhood just outside Oslo, the majority of cars are electric. Last year, Norway became the first country in the world to sell more electric cars than any other. In December, EV market share was at 67%. In 2025, the country wants all cars sold to be zero emission.
Hey, Norway, listen up, you fish-loving... Oh, this place is adorable. Damn it.
But why is Norway leading this development? The country is rocky, it's ice cold, and with huge distances. The easy answer is politics. By giving the consumers benefits that pay off, more people will go electric when they're getting a new car. These perks could be no VAT when buying the car, reduced tolls, the possibility to drive in the bus lane, and quite a bit of free parking as well. 2021 is an election year in Norway, and the Climate and Environment Minister Sveinung Rotevatn believe the EV perks will be a hot topic in the campaigns, where removal of the perks is set to be a central issue.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of specs. We remain very confident on the competitiveness of the Hong Kong stock market.
Tell us something you're doing that doesn't work out, where you've failed or something you can say you're not good at.
Let me tell you something. There is plenty that I am not good at and plenty that I've failed at, but I'm not afraid to fail.
We thought this might be a negative quarter. First quarter might be a negative quarter for the U.S. economy. That's clearly not going to be the case.
The U.S. is back on track to be the locomotive. The problem is it's not quite as large as it used to be.
There's good demand. For as long as that demand is there, it all goes well for paying for this crisis.
When you look at the core PCE deflator, it looks like we've killed inflation.
This has all the classic manifestations of a very frothy environment.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television, a simulcast on economics, finance, investment, and also what Lisa Abramowitz thinks about this great bull market. Once again, Lisa, green on the screen.
Yeah, there definitely seems to be momentum here, and it's being driven by a fiscal plan in Washington, D.C., and a bar that keeps getting higher, both with respect to how quickly we can get people inoculated in the United States, as well as how quickly we can get people back into jobs.
There's a huge news flow this morning. Lisa, let us stay in the markets here right now. I'll do a market check in a bit, but the salient moment of the last 48 hours is yields up, up, up. No reversal. Yields come in moderately.
Yeah, the idea here being that even though the U.S. is selling trillions of dollars of additional debt to pay for some of the fiscal spending, and even though people are expecting higher inflation, yields remain low. This comes ahead of the FOMC meeting minutes that we're going to be talking about that come out later today. This question of how much the Fed can keep their low rate policies, even as we see growth and inflation pick up, Tom.
And part of the new thoughts here into the earnings that we see April 14th is the idea of the divergence out there clearly in the zeitgeist this morning, at least, is the idea of the U.S. alone and leading the global economy.
And it really creates a conundrum. And on one hand, you've got higher yields that come on the heels of growth that's good when it comes to imports to the U.S., the money flowing out to the rest of the world. This is good. Yeah. But higher yields also attracts capital to the U.S., away from the developing world. And how much does that create a problem for debt repayment and perhaps investment going forward?
My conversation with Georgieva, we'll do that at 11:30 this morning, I believe. Kristalina Georgieva, the International Monetary Fund, she is on fire about aid needed needed for the rest of the world. Let me start with oil right now, $59.86 West Texas Intermediate stasis, but nevertheless weaker oil all in all. Over the last week, as Lisa mentioned, yields come in 1.65% in the 10-year yield. With it, the dollar comes in as well, 109.76 on stronger yen. Euro significantly stronger out of full big figure the last 2 days, 118.91. And in the equity market, up and away. Fractional returns, but nevertheless across the board, green on the screen. I need a brief. I mean, Lisa, I need a brief, like a 66-page brief, like Mr. Diamond's letter.
I think you got it. I think you got it on your desk. You can just take a look at it and ignore what I'm about to tell you. I will say, though, we're talking about international flows. The idea
Yes,
this, to
seriously.
me, is actually one of the main drivers, and perhaps the main driver behind why we're seeing lower yields today, despite the economic optimism. 8:30 a.m., we're going to get the U.S. trade balance for the month of February. We're expecting a record trade deficit. The U.S. has incredible demand. People have money. They want to spend it. It is coming from China, Taiwan, South Korea, and we're going to see a record potential deficit coming out at 8:30 a.m. 1:45 p.m., President Biden is going to be speaking about his infrastructure plan, no doubt talking about Amazon's Jeff Bezos coming out in support of higher taxes if they are to pay for this infrastructure plan. He's got an issue, though, because he's got problems on the Democratic side and he's got problems on the Republican side, and how he sort of pairs that difference, or how he even tries to, will really set the trajectory of the rest of his agenda. And 2 p.m., this actually is what I'm most interested in today, the Fed meeting minutes from their previous meeting, the idea of how much they're going to push back on market expectations for a rate hike as soon as the end of next year. The Fed has been saying consistently, don't look for a rate hike until 2024. The market is saying you can expect 4 rate hikes by then. Tom, how do they bridge that difference?
We will have to see, and it's going to be interesting as the Fed meeting there, as well as the World Bank and IMF spring meetings, of course, very much virtual this year. It is always a big event, and it becomes ever bigger as Mr. Diamond becomes ever more verbose. It is the annual letter, the Dear Fellow Shareholders letter of James Diamond, and it's not a letter, it is an essay of 66 pages, including fancy charts. There's a lot of emotion in there. Let's look right now at one of the moments within the letter, and this it goes, his primal scream about get away from the short term. The problem with the American public's impression of shareholder value is that too many people interpret it to mean short-term, rapacious profit-taking. He goes on to say, I've always loved that Ken Langone's Home Depot's company policy is not to raise lumber prices in the immediate aftermath of a hurricane. There's a lot of emotion here, slicing through the emotion and the statistics. Our chief Wall Street correspondent, Shonali Basak, joins us this morning. You're up to page 24. What have you learned?
Oh, man. Well, he talks about J.P. Morgan's own competitive threats, and he goes into steep detail about it, right? Fintechs, Google, Amazon, shadow banking system. But he also talks about the country, a racial and economic crisis, he says. And so he calls for a Marshall Plan, Tom. He says there needs to be a multi-year
A Marshall Plan for Jeff Bezos? Who's the Marshall Plan for?
For the country. Because he believes, he says, that Americans, and I think a lot of people do feel this way, have lost belief in their institutions, everything from government to schools to business.
Right. Well, this has been sort of the ongoing theme that we've been talking about this morning, the very political nature of the bank in this particular letter. Just sticking with the Google threats, what is he looking for? Is he looking for more technical regulation for tech that's trying to get into the financial sector? Is he looking for an acquisition? What can we read into this?
Both. He definitely signals the want to buy something. He's been doing that for a while, but the specific interest in fintech is interesting. He does lay out the size of evolving competitors, and he does lay out Google, Amazon, Facebook, Apple as a $5.6 trillion estimate, he says, about their size in this space. Again, it's not just technology, Lisa. It's other shadow banking rivals, people in private credit, hedge funds, private equity, AUM. Yes, regulation is a part of this, right? We've been talking about regulation for days, but it's also the recognition. The first page of the report is J.P. Morgan's, in Tom's favorite chart, return on tangible common equity. how much it's risen since 2008. There's a question, okay, how far can you edge that up as these competitors also start to abound?
Does this indicate that JP Morgan wants to get further into the consumer complex through big tech, through fintech? Is that the message here?
Well, listen, right? We already know that JP Morgan serves most of American households, right? JP Morgan, in their first parts of this letter, Jamie Dimon had gone into that specific role, what they mean in a household, in a community. To Tom's point with Home Depot, they talk about if you start a small business, you sweep the floor in front of the building so that nobody slips on ice, right? You take care of your community. So a lot of that is in this letter. I read it as a call for banks and other parts of the business community to stick with the economy, to stick with the parts of the country that are still very much in need as we start to come out of this, because it's not over.
Shonali, thank you so much. Shonali Basak this morning on a 66-page essay from Mr. Dimon. Right now in the equity markets, Amy Wu Silverman joins us with RBC Capital Markets, our equity derivative strategist. Amy, I want to get a little bit technical here, just, away from the basic equity block and tackle. What is the distinction in the derivative space right now? If you look out over the four cross moments, the variances, the skew, the kurtosis, if you look at the nitty-gritty of derivatives, what does it signal about this great bull market?
Yeah, great question, one that we're focused on all the time, Tom. And, look, one of your favorite words, skew, we watched that in great detail. And, volatility the past few weeks had been coming in a lot. You finally saw VIX, that was a sub-20 handle. That was broke down, pretty big deal. But in the last week, two things happened that kind of alerted me. The first was we got a spot up, volatility up situation. So, as the market rallied, you started to see volatility climb again. That's typically not a great sign. And then the second was that skew, our favorite imbalance between hedges on the downside versus leverage on the upside. That's going much more to the downside now across the board in S&P. That's not just the front month tenor we look at, it's 3 months, 6 months, and 12 months. And so it's kind of saying like, look, volumes are obviously quite low, but still there is caution coming. And it's not to a point that I would say there's alarm bells, but as we head into earnings season, I'll be very interested if that continues to tick up with nervousness in the options market.
How much can you blame the disappearance of marginal buyers, the idea that the retail traders have stepped away and started to spend money on things like airplane tickets rather than stock trading?
Yeah, it's so interesting because we look at that in terms of small lot option trades, right? So retail tends to be kind of 10 lots and under. That hit just absolutely historical levels in January and has been coming down ever since. I think to some degree, yes, it does matter. I know people they're sort of like love or hate on this. They're like, this just can't be something that's moving the derivatives market. It is. And the fact that they've stepped away and are, who knows what they're buying, vacation tickets, whatever for the summer, that is having a meaningful impact because I actually think that also bled into the VIX levels as well, because VIX obviously is just a normalized calculation of weights of S&P implied volatilities.
There's a number of articles out there now in the zeitgeist, Amy Wu, about the big cap, the big techs, the FANG stocks, if you will. What is your belief, your conviction they can continue ever higher?
Look, at the end of the day, the weighting on these mega cap techs, it really determines the course of the indices too. So I'll give you one interesting tidbit that probably is a little secondary in nature, but in derivatives, we think of the world in terms of delta. So that's just another way of saying, what do I think about Apple, let's say, going up 5% here versus 10% up from here versus 20% up from here. All the volatility in the kind of 5 to 10% up in these tech stocks like Apple have come in. So meaning there's less demand or belief that that's going to be the case. But interestingly, the demand for options that pay out if the stock goes up 15% or more has increased. So very low delta options have actually risen a lot in volatility, while higher delta options have declined. Now, how do we read this? There's a couple ways. One is, that is a trademark retail trade there. If they dip their toe in, they dip their toe in on the tails. But the other way to think about that is if the markets start to sell off, what is your flight to safety trade? Where do everyone goes back to again?
Yeah, where do you go?
You pay really, really, really low premium to get back into Apple, to get back into Google. So,
Amy,
I think
we got to leave it there. I got to cut you off, Amy Silverman. We'll do this longer next time with RBC Capital Markets. A busy day. Much more coming up here. Jim Bianco joining us at 8 a.m. Really looking forward to that. On radio, on television, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Joe Biden is ramping up pressure on Republicans to support his $2.2 trillion infrastructure plan. He's appealing directly to GOP voters whilst lawmakers are in their home districts. Today at the White House, the president will make his second major sales pitch for the plan in a week. He's facing opposition from conservatives and business groups who are against proposed tax hikes. Iran says a first day of talks in Vienna on restoring the 2015 nuclear deal were constructive, and diplomats will meet again Friday. But the Islamic Republic stuck to its demand that the U.S. lift sanctions first for real progress to be possible. Meanwhile, an Iranian ship was hit by mines in the Red Sea. According to the New York Times, Israel says it was responsible. The UK will begin rolling out the Moderna vaccine today. That comes amid concerns over the AstraZeneca shot and a shortfall of doses this month. The Moderna vaccine is the third approved shot in the UK. The success of the vaccine program is crucial to Prime Minister Boris Johnson's plan to fully reopen the UK economy in June. And the stage is set for what could be the largest private equity-led acquisition in years. Toshiba has confirmed that it has received an initial buyout offer from CVC Capital Partners. According to the Nikkei, the buyout could be worth more than $20 billion. Shares of Toshiba rose by the maximum 18% daily limit in Tokyo. And a warning from Morgan Stanley on investing in car makers. The bank's analysts say that auto investors that don't own Tesla stock risk missing out on an electric car boom. Tesla shares are down about 20% since setting a record in January. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
Ultimately, it's billions of dollars from the government that will pull that vaccine through and purchase it for Americans and people in low-income countries.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We would encourage all those developed countries that have the capacity using fiscal policy and monetary policy to continue to support a global recovery for the sake of the growth in the entire global economy.
The Secretary of the Treasury, Janet Yellen, there, moving forward the Biden mandate of what we're going to do to link in policy, fiscal policy and monetary policy as well. There's other policy, and that policy is I need to get reelected in November of 2022. Kevin Cirilli joins us, our chief Washington correspondent. Kevin, I want to look at both parties right now. Two-part question. What's the divide right now between Republican leadership and Republican troops? I mean, it just seems on issue after issue, the Republican troops maybe aren't aligned with Republican leadership. Is that true?
I hear you on that point, but yesterday's remarks from Senate Minority Leader Mitch McConnell with regards to Georgia in particular, in which he called on businesses and corporate CEOs to stay out of politics, that puts him right in line with Republicans in the base of his party. Look, I think just even beyond 2022, it's a fascinating time for the conservative movement because there also isn't a leader of the party in the sense that you won't have one until there's a standard bearer for the presidential cycle, and there are a ton, for lack of a better word, of Republicans who are eyeing 2024 runs. But to your point, I actually don't think there's as much division in right now because they're unified in their political opposition against the occupant in the White House, whereas previously in the last cycle they had to walk a fine line.
Are Democrats unified in their support of the occupant in the White House?
Yes, in terms of supporting for President Biden. No, in terms of their policy initiatives and where they stand on infrastructure, on where they stand on how much money they should be spending. Senator Joe Manchin, I don't mean to keep bringing him up. I sound like a broken record.
But you have to. No, I don't.
You have to.
You have to.
Tom, when he comes out and he's talking that he's against corporate tax rates and he says that the corporate tax rate increase that President Biden is proposing to raise, I mean, he's picking a fight with the left flank of his party, and that is a remarkable divide that has emerged in this infrastructure debate.
How does Joe Manchin hear Jeff Bezos' message in that Amazon letter yesterday where he said that he supported higher taxes for corporations to pay for this infrastructure bill?
You know, it's a great point. I think that there have been several CEOs, billionaires, who have said that they wouldn't mind paying additional money in tax allocations. But I think it's a different argument that Senator Manchin is making. Senator Manchin isn't talking about how much taxes he's going to pay. He's talking about what that would mean for companies who might be as a result of this, right, wrong, or indifferent, be looking to move offshore or to relocate. And so that, I think, is his argument.
So how is Joe Biden going to bridge the gap between Democrats and Democrats, let alone Democrats and Republicans today in his 145 speech on infrastructure?
So I mean, he's got to sell it. He's got to sell it. And
To
I
who?
think
But this is the question. To who?
He's got to sell it to the centrists in his party, because if Senator Joe Manchin, and there's some speculation, Lisa, that that Manchin could get on board with like a 24% corporate tax rate, which is a couple of percentage points below the 28% that President Biden wants. But he's got to keep his caucus together, and it is a lot of political capital that he has expended.
Kevin, what's the political future of someone like Jamie Dimon? I mean, you know, we all talk about it, and he was vetted to be Secretary of Treasury. Lawrence Fink of BlackRock, I believe, was in the sort of the same discussion at that point in time. But is there any evidence America will embrace a CEO, either appointed or elected?
I remember years ago, pre-Trump, when I was at a pen and pad briefing with Jamie Dimon, and he talked about one of his first jobs working in a baseball stadium when he was a kid, and how he really, you know, worked his way up to the top. And I think that's a uniquely American story, and I think that that if you can communicate in a way that highlights and captures the grit, hard work, and perseverance of America, I think there will always be an audience for that.
Interesting. I look, Kevin, at the moment today, and I guess everybody's back home. What do they listen to when they go back home, and what are they hearing right now?
Right now, it's can we get the economy back open? Yesterday, of course, there was a great article on the Bloomberg Terminal, Tom, about just how economists are surprisingly optimistic about just the unemployment numbers dipping lower and economic indicators.
Yeah, but also the middle class has been removed. I mean, there's a Pew Research and a lot of other people talking about at the same time the have-nots are still the have-nots.
Precisely, but with the economy reopening, I think that Republicans are going to argue that, you know, they want the middle class to get back to work, to have the opportunities to get back to work. Democrats are going to say the government is going to need infrastructure to invest in the middle class. But I think it's all to answer your question. When the lawmakers go home, the top, what I'm told that they continuously get asked about school reopenings, making sure that the economy reopens, and the best way to do that.
Kevin, in about an hour time, we're going to get the trade deficit numbers. We're expecting a record trade deficit. This after the trade war, after a lot of discussion about bringing a lot of commerce home. How does this read in Republican districts? What is the message that gets borne out, or is it completely independent just because of the pandemic?
I think the common denominator here is opposition against China and diversifying the supply chain. Both sides have different ways in terms of doing it, but I think China's the unifier for both Republicans and Democrats. The divide is going to be the Republicans are going to argue we can't afford to spend more money. Democrats are going to say, you know, we have to spend more money to invest in the future. But I still go back to this. Lisa. Republicans are still arguing collectively that they want to spend hundreds of billions of dollars, even upwards of $1 trillion on infrastructure. They're just not looking for $2.25 trillion.
Kevin Cirilli, thank you so much, our Chief Washington correspondent. Look for him. From sea to shining sea, sound on Bloomberg Radio, spirited conversations about the nexus of politics in Washington. Red and green on the screen, a churn to the market. And, you know, again, Lisa, I'm going to go back to we are anticipating earnings here, and it really creeps up in 1 week's time.
April 14th, that's when JP Morgan comes out, 7 a.m. Eastern time with their earnings. People looking for how much the savings rate has climbed in the United States ahead of the reopening that we're all expecting and that we're seeing on the margins. Again, though, the expectations are high. Are we setting the bar too high or too low? Person after person has come on and said, we're probably still setting the bar too low. And this has been one of the most difficult economic cycles to predict, Tom.
Yeah, I would say that we solidified up 1 quarter out, 2 quarters out, and the IMF braver goes out 2 years. I mean, I really thought Gita Gopinath was something yesterday in the conversation, less now, but much more the conversation to the end of 2022. And then James Dimon goes even further, and I believe it within his letter really goes out with more optimism to 2023.
Yeah, saying that basically because the spending on the fiscal side could go through 2023, so too could the economic boom. A lot of people seeing this, though. I mean, with Fed rate hikes expected and priced into the market, you know, 3 of them before 2024 after liftoff.
It is a movable feast, and I'll just look at the data, which is earnings are going to be bang up, certainly based on what we've seen of the first reports looking back a certain quarter as well. We'll drive forward this conversation. Ms. Betterly joins from Citigroup Private Bank, and we'll talk about the asset allocation within these markets. Red and green on the screen on radio and television.
Minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know the racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, give people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the U.S., we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy and we need companies to step up.
Madame Lagarde, has the balance of risk actually shifted since the last policy meeting?
Well, our balance of risk is still tilted to the downside in the short term, but it is much more balanced in the medium term.
What are markets exactly playing out at the moment? They seem to be continuing testing central banks.
They can test us as much as they want. We have a mandate, we have an aim. We're going to be riveted to that, and we're going to do what is required.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Bloomberg Surveillance, Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Mr. Farrow off for a good part of this week. Let me look at the markets now. Away from equities, we'll do that with Mr. Bostic in a moment. Real yield negative 0.66. A nominal yield in 1.66%, way down 567 basis points from the higher yields of a number of days ago. Dollar weaker. We're beginning to see that DXY 93 becomes 92.2. So we've seen some real weakness in the U.S. dollar with yen 109.82, euro 118.91, West Texas Intermediate 59.81, showing demand worries out there amid a U.S. boom economy. It's a boom stock market. Romain Bostic reports.
Yeah, I mean, we're coming off of yesterday, which was the lowest volume trading day we've had so far this year. So kind of hard for traders to sort of find those opportunities, even a little bit harder to piece together a market narrative. That narrative right now does seem to be coalescing, at least around the reopening part of this trade. You're seeing that reflected in a lot of these cruise line stocks. We talk about Norwegian Cruise Lines right now on a 5-day, 14% run. Looks like it's going to open higher here today, 6th straight day of gains. We are awaiting earnings from Carnival Corp today. And keep in mind, yesterday we had the CDC coming out and basically saying that it does believe that it will allow the cruise lines here in the U.S. to begin operating out of U.S. ports fully by midsummer, something that Norwegian has already intimated that it would be back in service by July 4th. Carnival saying something similar. We have yet to hear from Royal Caribbean, but a lot of people banking on the idea that we will see some normalcy there. You flip up the board, some of the other individual stories going on out there today involve DraftKings, of course, big legislation coming out of New York, setting up an online sports betting model. It's probably going to be run through the state lottery program, but you're seeing DraftKings, Skills, and a lot of the other sort of online gaming sites are really getting a bid here on speculation that they could be the potential winner of that contract. Beyond Meat opening a plant in China. And Upstart Holdings, interesting story here. Remember, this is a company that went public back in December, sold 14 million shares.
What is Upstart
it's now back.
Holdings?
This is an online lending platform, Tom. It uses AI and a lot of other sort of newfangled stuff, which is basically just a fancy way of saying they help you get a loan.
It's a Dow component. Okay.
Yeah, anyway, well, 2 million more shares coming to market.
You're killing it there today.
Absolutely. Yeah, thanks, Tom.
Is that
He
it?
is killing it. That's Tom. Where's John?
If we get lower volume, do you get to like take the afternoon off? Is that how it works?
I think so. I'll talk to my boss.
Talk to management on that. Romain Bostic, thank you so much.
you.
You will be there this afternoon for the close. Again, red and green on the screen. And right now we reset, and we can do that with Kristen Bitterly of Citigroup Private Bank, someone who has to explain to people where to find the courage. Kristen, thank you so much for joining. I really want to go right away to a wonderful phrase you have, which is that cash is punitive. And yet, I know cash is punitive. I don't want to be in it, but I'm afraid to go. How do you move from this wall of cash and the fear of missing out to get into the market? What's the first step?
It's so hard. So I think the first step is actually looking at the data. The reason that we have this association that cash is safe and cash is where I go when I don't know what to do kind of predates the global financial crisis, right? So if you look at pre-global financial crisis, if you were sitting in cash on a post-inflationary basis, you were earning about 3% per annum. Not knocking it out of the park, but that's all right. Post-global financial crisis, you're basically losing 1.2% per annum. And that's where we're at right now. So holding on to cash is basically guaranteed to lose value. On
a real yield analysis that other asset classes are inflated. I mean, you carry it right over to say, not so much the, I don't want to be inflammatory, there's an equity bubble, but elements of the equity market are bubblicious because I can't get a real yield in punitive cash?
I think if you look at the overall levels of equity markets, it doesn't really tell the full story. So when we're talking about the level of the S&P 500 being north of 4,000, which seems pretty incredible given the year that we've had, it doesn't tell you what's going on beneath the surface. And this is pretty intuitive, but one of the indices that we track at Citi is called Pure Value. So it's one of our indices that what it does in a very simple sense is it takes the stocks that are in the S&P 500 and it basically ranks them according to their exposure to value. As a factor, it's long the top 50% of those stocks, short the bottom 50. So it's a basic outperformance in terms of value. And so what we saw in March was that was the strongest performance. It was north of 6% that we've seen since second quarter of 2009. So that to me is when you're looking at what's going on under the surface is very different in terms of opportunities to put capital to work and delineating between those winners and losers in this environment.
So, Kristen, you're not just saying that cash is more punitive than GameStop shares. You're saying that people need to be investing in equities on an active level. This is everybody coming on and saying this is the year of active investment. Okay, great. But when you talk about allocations, what are you recommending?
So there's a couple of things that I think we need to keep in mind. This battle between, as I was just saying, value and growth, there's two trends that are driving the market right now. One is the mean reversion, right? So this is that catch-up trade, that idea that you had COVID defensives, COVID cyclicals, and basically the COVID cyclicals are catching up because of this reopening of the economy. The question there, which is why earnings are super important, is how much further can they go? So looking at some of these sectors in value in these COVID cyclicals that have had tremendous performance, how much higher can they go? So an area that we like there is actually global healthcare. So global healthcare is one of those sectors, and it's ironic, right? It's underperformed the past 12 months. From a PE standpoint, it's basically at its lowest levels on a relative basis to global equities in over 10 years. It has an attractive dividend yield. So that's an area that we like. But I think what's going to happen going into earnings is people are really going to pay attention to fundamental factors. They're going to pay attention to, has inflation actually creeped into any of these earnings? So I think we could get some surprises, which would create some buying opportunities over the next couple of weeks.
So in other words, you're saying wait for the pullbacks, and there could potentially be some opportunities to get some potential returns that are bigger. I'm wondering on credit. We're looking right now at credit spreads that are the tightest they've been since 2007, certainly in the high yield space. And when you start to talk about punitive cash, do you start to talk about people taking perhaps more risk than they're getting bang for their buck? Are you recommending that people follow this trade or pull back and go perhaps either into equities or into treasuries and nothing in between?
And so, yeah, so that 300 basis point spread, right, kind of going through that was something that is pretty symbolic and significant. I think a lot of people are looking at this in terms of comparing it overall high yield to equities and saying, well, if we're looking at it on a relative basis, there could be an additional 50 basis points or 100 basis points. We're not quite there yet. We're definitely delineating in terms of the sector analysis within high yield. But another area, talking about equities again, so UK equities is another area that's been largely ignored. We're looking outside the US in terms of trying to create some of this yield, where you can get 3.5% there. And again, valuations look very attractive.
Krista, not that you and Lisa would know this, but long ago and far away, you bought Dominion of Richmond, Virginia. You bought it, you held it, you never sold it. And it's been a solid 30, 20, 10-year high single-digit return.
Hello, traders. Okay, it's time to sell short Japanese yen. And I'm going to place order at 109.828 to sell Japanese yen. 109.828. Okay, order placed. So if you're looking to sell short Japanese yen, please do so. Please place an order if you decided to follow my trades, and stay with me, and I'll let you know later on what's going to happen, how we're going to trade this pair. Okay, I'll speak to you later, guys. Stay safe.
Than anything else, and you get some pretty broad diversification.
Lisa.
Part of that's energy and utilities, but you actually get financials, healthcare, even technology.
I feel so ancient, Lisa. I was trying to go Graham, Dodd, and Coddle, and Kristen just crushed me with the modern free cash flow analysis. I was just totally crushed there, Lisa.
Well, hopefully you can recover in the next few minutes, and hopefully we can drag you out of the hole. I will say, Kristen, we got to end the conversation, perhaps crushing Tom even more and talking about taxes. You know that you deal with a lot of wealthy individuals, and right now we're looking at potential policy changes in the U.S. that increase taxes on the wealthiest, particularly in New York State, but beyond on a federal level. How is this affecting the investment strategies of the people who you work with?
You know what's interesting? It's not priced into the market at all. So another thing, and this goes back several years ago when we had the tax reform, we started monitoring basically kind of the tax winners and tax losers in terms of the tax reform. And so looking at the reversion of that trade in terms of increasing the corporate tax rate, basically you haven't seen anything play out within the market. So for people who are interested as these talks progress in terms of expressing a view from an entry point standpoint, that's actually pretty attractive. In terms of what it could mean from a personal standpoint and how you invest, I think putting it into context when we did have those tax hikes, and I think we have to go back to 1993 and 1987, and the impact of that on the overall market, and it looked like on average it was about 5 percentage points So in that sense, kind of putting it into perspective as to what that impact could be, I think is helpful. And then in the larger rates environment, we don't see a lot of either trading around that or investing around that at this point in time.
Kristen, thank you so much. Kristen Bitterly there, sharp from Citigroup Private Bank there on the many challenges we all have to find courage within this market. Lisa, Barry Ritholtz out with a really smart chart this morning out on Twitter, of course, with Bloomberg Opinion and his acclaimed podcast. Mr. Ritholtz looking at the breadth of this bull market, really up to levels we haven't seen in 10 years.
Yeah, actually, I was going to say a lot of people are participating and getting the bravery to get into this market. Some people staying in triple leverage cash. I mean, it's sort of like, how do you take those people who are in triple leverage cash and encourage them that they're being penalized for not taking more risk?
It's punitive.
Just throwing that out there, Tom.
The triple leverage punitive fund. That's where we are right now. But, you know, I think, Lisa, a very important concept here is it's not like a mutual fund 30 years ago, as Kristen Bitterly mentioned. It's not about putting all your cash to work. A huge part of this $1 trillion amount of cash, many trillions of dollars, I should say, is never going to go into the markets. It's not supposed to.
No, and there's a reserve issue here of the banks just having huge reserves and the central banks creating these pockets of liquidity. That said, there is a lot of cash still going into the market, which raises questions about how much froth there could really be. Jamie Dimon talking about froth in markets without specifying exactly what he was seeing. And this seems to be the tone out there. Yes, there is some kind of froth out there, but I don't want to identify it. Maybe crypto, maybe something else.
And this is really interesting in that we have a day of a 66-page letter from Dimon. William Dudley, the former president of the New York Fed, writing a short essay for Bloomberg Opinion, raised the leverage ratio on the banks.
Yeah.
That is a whisper of 2004. Bill wouldn't like me to say that. We'll speak with Mr. Dudley here in the coming days. On the pandemic from Northwestern, on how society copes, Mercedes Carnathon. Stay with us on radio, on television.
With the First Word News, I'm Ritika Gupta. The richest person in the world supports investing in U.S. infrastructure and raising corporate taxes to help pay for it. Still, Amazon CEO Jeff Bezos stopped short of endorsing President Biden's $2.2 trillion infrastructure plan. In a statement, Bezos said the investment will require concessions from all sides. The U.S. says it will consult with allies about how to handle the 2022 Winter Olympics in Beijing. That sparked discussions of a possible boycott over China's human rights record. Last year, more than 160 human rights groups urged the International Olympic Committee to hold the Beijing Games elsewhere. France has been discussing a global minimum tax on businesses with the U.S. We spoke with French Finance Minister Bruno Le Maire in an exclusive interview here.
There is a unique window of opportunity to have a new international taxation system which would be more efficient and fairer. We are having very in-depth discussions at the technical level between the French administration and the American administration on this matter, but I think that we should all do our best efforts to reach an agreement by next summer.
Le Maire says France is open to a higher rate than the 12.5% being discussed. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Okay, traders, I probably have to cancel order to sell short because it moved down quite rapidly. In the meantime, I'm going to place order to sell short British pound. Okay, I'm going to sell short at price 138.240. Just up, you will still have time to place an order at this level, 138.240. Okay, order placed. Okay, we filled with British pound, and I'll cancel right now Japanese yen. So if you wanted to trade, let's wait for better time, because as you can see, it moved down quite rapidly. Order to sell Japanese yen cancelled, and we filled with British pound. You still have time, guys. If you want to trade British pound, it's moved up, so you can enter this position at any level, and I will tell you what we're going to do next. We never sell, put stop loss. We always place stop on profit. If you want to find out how and why we do that, you need to get the strategy. You can get it from our website, company.co.uk, or you can get it from our stream. But we never placed stop loss. Okay, I'll speak to you later, guys. Stay safe.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
We've also started developing, just in case we need them, additional mRNA vaccines that will target some of these variants. So whether it's a variant vaccine or the original vaccine or some combinations of these, we want to be 1 or 2 steps ahead of the virus as it manifests changes to fight back against our immune system.
The leadership of Moderna there, Noubar Afeyan, speaking on the vaccine, driving the message forward, as Pfizer and J&J do as well. Korea drives a message forward on AstraZeneca. Astra's vaccine for those younger than 60, it will be suspended by Korea. That is quite a statement as well. Right now, and I guess this is an important discussion. This is something that Lisa and I in our pre-show meeting said is really top of pile. Forget about the IMF, forget about James Diamond. How do you travel with the young hellions? Mercedes Carnathon is in charge of family psychiatry for the Abramowitz and Keene households and joins us this morning from Chicago.
You got work to do.
Mercedes, let's cut to the chase here. And this is important. We make a joke about it, ill-mannered brats that they are. But you say traveling with children is risky. I don't understand that. Why is that risky in this pandemic?
It's really tough. I think we're all eager to get out. I mean, I've been home with these children now for, 14 or 15 months. I'd like to go. Whereas my husband and I are vaccinated and our older adult family members are now vaccinated, my children aren't. So if I take them with us, then I'm exposing them to risk of these new variants, which seem to really infect children.
Then what do we do on that? I mean, of everything we've talked about today, and frankly, this week on the show, Mercedes, that is the single boldest statement I've heard. Are you saying we cannot open up this nation because of true medical risk to our children?
Well, I think an estimate was that 25% of our population is children. We're all racing toward this herd immunity, and we're estimating that we need to get 75% of our population vaccinated. Well, 25% are not currently eligible for vaccination, and children do contract COVID, and children do spread COVID. While they don't have as severe of outcomes as adults, they do get it. And so we're going to continue to see it circulate. I want the nation to open up. I want out of my basement. I want out, I want to go somewhere warm, but there still remains a risk to me taking the children with us.
All right, so let's talk about what works. I mean, can you stick a mask on them, bring them into the plane, and basically say, wash your hands a lot, and you'll be fine? I mean, what do we actually know still at this point about how to prevent it in order to live your life to some degree as more people get vaccinated?
Absolutely. The mitigation measures that have held us up this long, masking, distancing, those measures are still in effect. And so it is fine. You can make sure your children wear a mask, make sure they know not to lick the, back of the plane seat in front of them. And you can make the trip, don't do that. You can make the trip as safe as possible, but you have to be adherent to this. If your state has travel quarantine rules when you go somewhere, whereas vaccinated individuals don't have to quarantine, you may not send your children back to school or on play dates after they come back from a state on a quarantine list.
So let's talk about some of the science behind this. First, I'd like to get your sense on how severe the disease and some of these variants could be for children, and also the idea of kids aged 12 to 15 getting vaccinated before the school year starts again. How likely is that, given some of the models of Pfizer?
What is this, a doctor's appointment? I mean, come on, Lisa.
She's our advisor, our psychiatric advisor for the Keen and Abramowitz household. So there you go. Mercedes, help us.
Yeah. I think we do have to keep the risks in perspective. Children contract COVID. They do become ill from COVID, but by and large, the leading cause of hospitalization and death in children are unintentional injuries. So let's think about that. Certainly your child can contract COVID. The likelihood that they'll be hospitalized from a car accident, a bicycle accident, remains higher. So, it is all in perspective, but, you never know. You don't want your child to be that child. I do look forward to the progress that we're making in vaccination of younger children. The 12 to 15-year-olds are soon to become eligible. You think about sports leagues and performance theater and the things that are really important to the mental health of children of that age. They can return.
Mercedes, I just want to know if they can do a day trip to Sephora. I mean, that's all I want to know. Mercedes,
absolutely.
I got, we talked to all sorts of muckety-mucks on this show. You get more mail than anyone. This in from Western Indiana. Baby Charles is not a hellion. We're sorry if we insulted anybody in West Indiana. And also they go on to say, Baby Charles must see Turks and Caicos. Mercedes, cut to the chase. Okay. I need to travel this weekend. It's on the Gulf Stream. I'm taking baby Charles to the Turks and Caicos. Is that a wise thing to do? Seriously.
You know what? Everything is a calculated risk, and I would never deign to say somebody absolutely shouldn't do something and it's a terrible idea. The likelihood of your child becoming severely ill is low, but it does happen. And just be aware, you could end up getting quarantined down in Turks and Caicos and not be able to come back if somebody tests positive down there.
Sounds brutal.
Well, except it is, because then you get locked in your room.
Oh, that's terrible.
You mean by the pool? Yeah.
They'll send an email back. I'm saying, Mercedes, go away. You're giving them way too many. You're giving them way too many ideas here. I'm sorry. Charles has a headache. He can't come back.
Tell your boss. I was, doing my public health best, and I had to quarantine in Turks and Caicos. But,
They're very good.
The accounts I've read are not fun.
Mercedes Carnathon, go away. With Northwestern, and seriously, their university professor of preventative medicine, she is literally best in class and talking about the social aspects, the hardcore medical data aspects of what this means for society.
Okay, traders, it's all about stop and profit, and I'm going to play stop and profit
about 38,000 people
for
the Texas Rangers baseball.
British pound.
At least I checked.
And the price I'm looking to sell if direction will be changed, 138.22. It will give us 2 pips. In your case, you have to find out how much broker pays you per pip, and whatever happened, you will end up in profit. If you decide, if you decide to move lower, you need to wait until the price will move rapidly lower. As you can see, if you started follow our trades a couple of weeks ago, as you can see, we're still holding positions for British pound. So I'm planning to sell whole positions, but it's supposed to move lower to the level of around 138. So if it will move that lower, at that level, I will sell all positions and I will collect my profit from my long position. If not, if price will change its direction, I will end up with small profit that, in my case, £200. Okay, I'll speak to you later, guys. Stay safe and good luck with this trade.
Please stay with us through the morning. Much more to come, including my conversation with Kristalina Georgieva later. Jim Bianco next. This is Bloomberg.
This patch of land in northwest Saudi Arabia is going to become Neom, a city powered entirely by renewable energy. The government hopes the site, which is the size of Belgium, will be a clean energy hub, not only for the kingdom, but also the world.
This here is at the borderline between Mission Impossible and Suicide Mission. Lucky enough, so far we've just been on the right side of the line, yeah. But you know, it's very close to that. You know, this is just smoking. This is nothing ever I've seen or heard of the dimension, the challenge. You know, I'm not talking energy only. You know, but in its broadest context, including the geopolitical dimension, including the cultural dimension.
Neom will include a $5 billion hydrogen plant run on wind and solar energy. All of the zero carbon fuel it produces will be shipped to international buyers in the form of ammonia. When it starts operating in 4 years' time, it will be one of the biggest hydrogen facilities in the world.
Can't explain Neom on the back of a set of PowerPoints and a video clip. You just need to be here. You need to, breathe it. And specifically the startup mode and, things happening. Buzzes all around you here.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television. And Beverly Chang explores how a chip shortage snarled everything from phones to cars on a Bloomberg television special, Chip Crunch, Wednesday on Bloomberg Technology.
This might be a negative quarter. First quarter might be a negative quarter for the U.S. economy. That's clearly not going to be the case.
The U.S. is back on track to be the locomotive. The problem is it's not quite as large as it used to be.
The gap between those performing well and those who are still struggling is just growing by the day.
As the market rallied, you started to see volatility climb again. That's typically not a great sign.
We're shifting into the commercial side. That has great power. That could really make 2023 even better year than 2022.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
American optimism faces off with fear of the Fed. Good morning. This is Bloomberg Surveillance on Bloomberg Radio, on Bloomberg Television. Tom Keene, Jonathan Farrow, Lisa Abramowitz. Jonathan Farrow is off. He will be back tomorrow on a well-deserved break, and he will not be necessarily quarantining because he will definitely want to avoid more discussion from you, Tom.
Well, we'll see. We'll see if he has to go through quarantine, and if he does, he'll do it remote as well. We say good morning to all of you. A very important day, and wrapped around all this, as you just heard from Robert Albertson of Piper Sandler. And Lisa, to me, it is the quiet message of this early week. We're starting to see people extend out from 2021 to 2022 analysis, and Albertson talking there about 23 as a continued good economy.
Well, and it's not just Albertson. It also is Jamie Dimon, who's saying that he sees the momentum going out another couple of years, and this is on the heels of U.S. spending. But this goes to the ultimate point. At what point does the Fed have to recognize inflation, recognize growth, and hike rates sooner than they have said? Market is saying that that will happen, and the Fed is continuing to reiterate, no, it won't. And that is a tension that needs to be resolved in the upcoming months.
I'll editorialize here, Lisa. I feel very, very strongly about this. The central banks, by definition, are always ex post. They are going to wait until they see the inflation. They're not going to get out in front of it like so many talk about in the media, and we'll just have to see step by step out to 22. But the answer is you got to get the unemployment rate down, let's say under 5%. And then
I'm going to place my stop on profit for British pound even lower at 138 to 19, actually 138.19 stop on profit placed. And let's see what's going to happen with, with 6 pairs. In this case, we will have 5 pips. It equals by 500 pounds. So if you decided to follow me on this trade, please place stop on profit at 138.19. Okay, guys. And let's see what's going to happen next.
0.91. Amy Wu Silverman, RBC Capital Markets. I thought she was very prescient there about this gap down in the VIX to a more compliant, a more complacent market, I should say. 1.66 on the 10-year yield. Dollar comes in 92.93 on DXY. Euro with a leap, 118.87. Good to know that, Mr. Farrow and Capri. As he is based in euros right now, and oil under $60. We try to summarize all this, and of course the summary as well wrapped around 66 pages from James Dimon. Right now, Jim Bianco joins us with Bianco Research in Chicago with a wonderful overview on the market. Jim, I assume you haven't read the 66 pages of of Mr. Dimon. It's wide-ranging, as you would imagine. Let's look right now at one of the quotes from Jamie Dimon. Let's zoom in on a quote on Zoom. Jim Bianco's lived with Zoom. Lisa Bramlett has lived with Zoom. I am Zoom-free. I'm really pleased to say that. But let's look at Jamie Dimon on Zoom. Most professionals learn their job through an apprenticeship model, which is almost impossible to replicate in the Zoom world. Over time, this drawback could dramatically undermine character and culture. Remote work virtually eliminates spontaneous learning and creativity because you don't run into Jim Bianco at the coffee machine. I mean, there it is, old school Jim Bianco. Do you think we return to our offices of old?
Sort of. I'm going to push back on that quote a little bit.
Please.
I'm going to say, yes, it is, human interaction, human contact is important, but not, I don't think, in the form that Jamie Dimon is suggesting that, 10 hours a day in an office, sitting in a little room by yourself, working at a computer in a service sector job. I think that we're going to have to rethink what the office is and rethink why we go to the office. We've just shown as an economy over the last year, we can produce the economy just fine, all working remotely. And I agree we need more human contact. Look, I want nothing more than to go to a Wrigley Field game again. But I also recognize that maybe I don't need to go to one of those gigantic buildings in the center of a major city and spend 45, 50 hours a week there as well, too. There's going to have to be a rethink as to what exactly does the office mean. And it sounds like some people are not there yet as far as having that conversation.
What is the Bianco creative destruction then, and how do you prosper from it? What is your investment strategy given what this pandemic has wrought in the boom economy recovery?
I think the biggest thing with the boom economy has been all of this stimulus, the mailing of checks that we've had. We've got the savings rate at a 60-year high. We've got everybody itching to get out. That's what everybody says right now, and I think it's very true. And when they do, I think we're going to start to see spending go. That's what everybody says. And then we'll have to have a real conversation about inflation. It's too early to have that conversation about inflation. The base effect of dropping off March and April of last year and seeing the year-over-year numbers go up a lot is literally going to start next week. And the checks that we just recently mailed out have only been a couple of weeks old. So I think as we move forward, we're going to have a conversation about inflation and whether or not we see it. If we see it, it's going to have to accelerate the Fed. If we don't see inflation, it's going to open the conversation to modern monetary theory and more money being spent at a higher rate than we're already doing it right now.
What's the nature of the pickup in inflation that you're looking for? And this is important because we've seen inflation of certain key goods, but what is the important increase in inflation that you need to see to say this is a sign of something different?
I think it's probably going to be that companies are going to raise their prices. Look, we've known now for the last 25 years, if you're a manager of a real company, not a Wall Street company, let's define those two, and you raise your price for washing machines or you raise your price for sweaters, you're on the second page of a Google search on lowest to highest price. You don't sell anything, you lose market share. Everybody's been droned into don't ever raise your price because of that consequence. If we get to the point where there's a demand pull that so many people are wanting stuff that we start seeing prices start to be raised, then in Fed speak, we've unanchored inflation, and we could then start to talk about whether or not it is actually here for the first time in a quarter century. I think that's a real possibility as we move forward, that we could see that unanchoring of inflation.
So we're seeing 10-year yields today go down. They are well down their recent highs, which raises a question of whether they are underpricing this reality that you're talking about. Where could 10-year Treasury yields conceivably go if you see those inflationary pressures that you're talking about?
Well, I think they could go higher. Now, I'm not surprised that they're falling right now because they've had a relentless rise for the last several months and have been, oversold in terms of prices, and that we're seeing a correction in there. But I also would argue that when interest rates go up, it's neither bullish or bearish for the stock market. It depends on why. If they're going up because the narrative right now is we're reopening, we're going to have massive real growth, we're going to have more earnings, that's fine. Interest rates could go up and it won't bother the economy or the financial or the stock market, if you will. But if interest rates are going up because of inflation, and that's a loss of purchasing power, your dollar buys less in a year than it buys now, that's a problem for the economy and for the stock market, and we're going to continue to have that debate. In the meantime, I think rates are going to go higher like they have over the next several months, like they have over the previous several months, and we're going to continue to have this debate whether it's reflation or real growth or inflation.
I mean, I hate to say it to James Dimon, Jim Bianco, but the read of the morning is Brian Chapata at Bloomberg, not Jamie Dimon at JP Morgan, where Chapata tears apart the idea of wages aren't going up. Are you seeing wage inflation in Chicago? And to the point, is that really what's going to happen here? A surprise into the end of the year, finally wage inflation gets back to 3-ish%.
Yeah, it's hard to say whether or not you're seeing it right now, but that's going to be the question as to whether or not you do see wage inflation as we move forward. If you do, then you might see a bigger, robust job market, because a lot of people are sitting on the sidelines. They don't need to go back to work. They've been given stimulus checks. They've been given an extra kicker in unemployment insurance. So they're sitting around waiting until all of that runs out. If we do see wage inflation, I think then, like I said, it would fast forward everything like the Fed and the thinking in the market. But right now, it's too early to say that we've seen it. But I think that's going to be the second half of the year question.
Jim Bianco, thanks so much. Go Cubs. Bianco Research in Chicago joining us this morning. Lisa, I think this is really the heart of the matter. Chapata's essay is extremely strong on the what if out there, and it's just different parts of the economy. And you wonder if there's going to be wage inflation there, as Brian identifies. There's got to be someplace where there's not wage inflation. That's really maybe the major focus.
A lot of people were talking about the services sector, saying that, yes, it was going to come back in speed, but there's so many people still out of work. And yet you are anecdotally hearing about employers having to sweeten the pot, basically, to get employees in the door. How long-lasting is this, Tom? Is this just basically a flash-in-the-pan event as we deal with the friction of trying to bring an economy back online, or something that has legs?
I've got the Chapata essay out on Twitter, and it includes comments from Tom Porcelli of RBC Capital Markets, who's been so good on wage dynamics. Right now, red and green on the screen. Futures flat, Dow futures up 30 as well. In the bond market, a churn, as Lisa mentions, yields come in over the last 3 or 4 days, 1.66% on the 10-year yield. I should note the 2-year yield, 0.15%. We haven't seen much curve dynamics here in the last few days. In Europe, pretty much quiescence with euro stronger, 118.84. He has been absolutely brilliant on pushing aside the fears of inflation. We get an update from James Sweeney of Credit Suisse, our chief economist. Later this morning, Kristalina Georgieva of the International Monetary Fund. Stay with us. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Joe Biden is ramping up pressure on Republicans to support his $2.2 trillion infrastructure plan. He's appealing directly to GOP voters whilst lawmakers are in their home districts. Today at the White House, the president will make his second major sales pitch for the plan in a week. He's facing opposition from conservatives and business groups who are against proposed tax hikes. Iran says a first day of talks in Vienna on restoring the 2015 nuclear deal were constructive, and diplomats will meet again Friday. But the Islamic Republic stuck to its demand that the U.S. lift sanctions first for real progress to be possible. Meanwhile, an Iranian ship was hit by mines in the Red Sea. According to the New York Times, Israel says it was responsible. The stage is set for what could be the largest private equity-led acquisition in years. Toshiba has confirmed that it has received an initial buyout offer from CVC Capital Partners. According to Nikkei, the buyout could be worth more than $20 billion. Shares of Toshiba rose by the maximum 18% daily limit in Tokyo. And Target is promising to buy more than $2 billion of products from hundreds of Black-owned brands by 2025. The discount retailer also will help Black vendors expand their sales in big box stores. Target is headquartered in Minneapolis, site of the murder trial of the former police officer who killed George Floyd. And a warning sign from Morgan Stanley on investing in car makers. The bank's analyst says that auto investors that don't own Tesla stock risk missing out on an electric car boom. Tesla shares are down about 20% since setting a record in January. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Asia is absolutely core to our business. It's almost 20% of our franchise revenues globally, which is significantly more than most of our global peers who are more in the mid-teens.
We want to invest, grow in China, but also we are also investing in the rest of Asia as well. Our top line growth for the region has been close to 24% last year, almost 20% of the group's revenue as a percentage of the revenue of the group. So, and this is where the group is counting on the growth.
We see company after company, these are corporates committing to net zero. So pretty much across the board, there is an enthusiasm for putting capital to work to try to get us to a better carbon future.
Credit Suisse has a fantastic brand name in Asia. We have obviously strong positions in Singapore and Hong Kong as our two main hubs, but across the region.
Tell us something you're doing that doesn't work out, where you've failed or something you can say you're not good at.
Let me tell you something. There is plenty that I am not good at and plenty that I've failed at, but I'm not afraid to fail.
Never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Could see countries that have very high levels of vulnerability, high foreign currency borrowing, high dollar borrowing, that there are risks to them. But again, it's not like we are seeing any kind of a systemic debt crisis.
Gita Gopinath, head of economic research, chief economist at the International Monetary Fund, out with a really divergent set of outlooks in the last 24 hours. I'll be speaking with her colleague, her boss, I should say, managing director Kristalina Georgieva later this morning. Look for that. That's going to be a piercing conversation. Georgieva is heated about the need for aid to a large part of the world suffering in the pandemic. HSBC drives forward the conversation James Dimon drive forward this morning. Lisa, 40,000 roughly UK employees, and a good percentage of them, not a minuscule number, 1,200 will make permanent home working. That's a bit of a surprise.
Well, this is the ultimate debate that's going on Wall Street and frankly throughout corporate America. And it's not just Jamie Dimon weighing in on this, saying it's important to get back to the office and that Zoom calls are really leading to massive Zoom fatigue. Tom, I know you don't know anything about that. BlackRock's Larry Fink coming out also this morning and saying he cannot wait to get back to in-person meetings. He's going to emphasize those and the idea of casual conversations being fodder for incredible creativity and innovation. Really, this is going to be one of the big divides heading into the next era. And right now you're seeing big companies take on less office space in some of the big city centers, Tom.
Right now, Laura Davison joins us. She has done something very cool at Bloomberg. Of our 19,000 employees, she's gone into something and carved out a competency and ability that it benefits all. In this case, it is on the taxes of the nation. Laura Davison out of Missouri joins us this morning. Laura, when are my taxes going up? Is it a date or is it rhetoric right now?
Right now, it's rhetoric, but it has a lot of momentum, and there is a relatively high likelihood that there could be a tax increase of some sort that goes into effect January 1st of next year.
Are we into a yo-yo where over the years we'll see Republicans cut tax, Democrats raise tax, or is there some form of cyclicality or length to this debate like there was in my youth?
You know, this is really the question, and this has tax lawyers and, particularly tax advisors for big corporations worried that they can't plan anything because, whatever the law of the land is today is going to be totally overhauled 2 or 3 or 4 years later. The question is, how does the balance of power in Washington keep shifting? We saw Republicans had unified control, then Democrats came in. The question is if they can hold on, after Biden's first 4 years is up.
Laura, the debate seems to be theoretical and faith-based in Washington right now. Either taxes going up is a bad thing for growth, is a bad thing for corporate innovation, or it's a good thing for the nation. It pays for programs that will add to growth and help corporations. These bifurcated ideas, are they backed by facts? Are they backed by studies? What are the studies that are underpinning the debate today, Laura?
So there's not a ton of data yet out about the Tax Cuts and Jobs Act, about how effective it's been. But Democrats point to, they say, look, there hasn't been the growth we've expected. We would have expected more growth by now. We didn't get the big surge in investment. Corporations have largely kept these big offshore tax structures in place. We need to do something different. That's the argument that Democrats are making. And there's some evidence there, but Republicans also say, look, we really, this has only been playing out for 3 or 4 years. Treasury hasn't even finished, implementing all of this. We need to give this more time. So there's some arguments on both sides. There's maybe a little bit more data supporting Democrats on this, and particularly looking forward at, there needs to be revenue for investment, and that needs to come from somewhere. And there's just not enough money from user fees to make that happen. So it's likely that taxes of some sort need to go up at some point soon in the future.
On a more mundane note, there's a question that Treasury Secretary Janet Yellen raised a couple of weeks ago, saying the easiest way for us to collect more taxes would simply be to crack down more on the existing rules, to hire more people for the IRS and go after people a little bit more. What's the likelihood of that happening, at the very least in the near term?
That is one of the probably most likely things to happen. Both Democrats and Republicans agree that the IRS has gotten a little too lax in its auditing practices in recent years, and that's largely due to budget cuts. So there's a bunch of studies that have been done, basically show for every dollar you give the IRS, they can get an additional $3 to $5 in tax revenue back. So that's a pretty good ROI. The issue there is, there's only so much unpaid taxes out there that the IRS can go and collect. There's not, $2 or $3 trillion to pay for a big infrastructure bill. There's maybe a couple $100 billion.
Are we moving to a more progressive system, the layered, ever-increasing marginal rates of my childhood? Are we going back to that?
Somewhat, we're not going to see, Democrats at least right now aren't proposing, rates up into the 50 or 60%. The top rate they're proposing right now is about 40%. Though there's some counterweights on that. Democrats in the House in particular are saying, if we tinker with the tax code, if we raise taxes, we also want to restore that SALT, that state and local tax deduction, which would actually make the tax code less progressive. So we could see some sort of, some things moving in one direction and things moving in the other direction as well.
Yeah. We've got to leave it there. Thank you so much, Lord Davison. Greatly appreciate it. Bloomberg tax reporter. Lisa, all of a sudden, the markets with a move. Futures -4, Dow futures -29. And, after it's been quiet, if you will, mortgage applications out at 7 a.m. I don't see much economic data here, but nevertheless, a real drop down here. Well, in the markets, the yield 1.66%. Lisa, what do you see?
It's a churn, honestly, and it's very quiet. Yesterday was the slowest day, what Romain was saying, the slowest day of trading of 2021. Just to give you a sense of the fatigue, perhaps either from Zoom calls or from 12 straight months of working from home with your, to quote you, Tom, hellions, in tow. There is a question, though, here going forward. What is going to tip the balance? There is a show me the money feel right now as we wait for earnings. There's a show me the Fed message as we wait for the Fed speak, both later today with the FOMC meeting minutes as well as Chair Powell later this week. There's a question right now, where are we going to see the tip of the balance? Is it going to be higher inflation, higher growth, or is it going to be lower, a retrenchment of some of the pretty high expectations that we have currently, Tom?
Yeah, and what's so important here, again, I'm going to go to this, we're in this vacuum, if you will, out 7 days, I should say, to the JP Morgan and the bank earnings and all that, and then we really get into tech. And I think we really reset, Lisa, into the 3rd and 4th week of April. I mean, I really feel that very strongly.
I feel fatigue. I mean, not just personally, but I mean, I think pretty much across the board when you speak to people, how many people say, I need a break? I mean, honestly, Tom, I mean, people who haven't taken vacation because there was nowhere to go, and people have been sort of grinding it out. Well, no, but this is a question. How much is that what we're seeing in the market right now? Or people are saying, maybe I'll just take a few days off.
I mean, I haven't been off since, last week. We won't go there. I do want to point out something that I'm watching out of the corner of my eye, and that is with the calmer tone out of Jordan and the Transjordan. This, of course, east of Israel, is to look north to Turkey, where there's a bit of an unraveling. An 854 level on Lira is my definition of unraveling. We are not there. But we do have a weaker Turkish lira over the last 2 days, to 8.19 this morning. For those of you on the EM watch, I think that bears very careful review. Futures deteriorate. We were green on the screen an hour ago. Now -4. Dow futures -33. The VIX 18.01. Coming up, our conversation of the day on inflation. James Sweeney of Credit Suisse. Stay with us on radio and television. This is Bloomberg.
such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
Ultimately, it's billions of dollars from the government that will pull that vaccine through and purchase it for Americans and people in low-income countries.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Good morning, everyone. Bloomberg surveillance, lots going on. Futures deteriorate. We were green on the screen, and we've just given it back a little bit within the low volume that we've talked about. Futures -3, Dow futures -30. Kaylee will talk about that in a moment. The yield comes in as well, 1.66%. We've got some important airline headlines out we'll get to in a moment. First, Kaylee Lines.
Well, Tom, 1 hour to go until the U.S. opening bell, and as you said, we have seen futures deteriorate really in just the last half hour or so, but it is very fractional moves. We're only down about 3-4 points on S&P E-minis, and we've been fluctuating during the entire futures session. Now, as we've seen futures moving lower, we've seen yields come off the lows of the session. We're now basically unchanged on the 10-year yield as the dollar gets back a bit of its strength. And keep an eye on crude as well. Talk about fluctuations during this session. Right now, WTI is higher by 0.6%, though still sub $60 a barrel. As for some stocks to watch come the opening bell in an hour's time, keep an eye on Beyond Meat. It is opening a manufacturing center in China that has shares higher by about 2% in early hours. DraftKings is up 1.4%. New York State, right here where you and I are, Tom, ready to approve gambling, online gambling rules outlined by Governor Cuomo.
Money on the Red Sox. Thank you.
If I had bet money with my March Madness bracket, that would not have gone so well for me this year, Tom. Also, I would keep an eye on cruise stocks. The CDC saying cruises may be able to resume in midsummer with some restrictions. That's a win for players like Norwegian and Carnival, each up 2 to 3% in pre-market trading. Not sure if you've booked your summer vacation yet, Tom, but maybe a cruise could be an option.
Bramowitz has all my vacation days in the summer. Kaylee Lines, thank you so much. There's a set of headlines out right now. Evans of Chicago, achieving the Fed's inflation goal may prove more difficult. We'll talk to James Sweeney about that in a moment. Lisa, what I like about the airline headlines from IATA, the global counters of heads flying around on airlines, is the view forward to May to September.
Yeah, and how bifurcated that view is, whether you're in the U.S. or China or whether you're in Europe. Just to give you some context, the International Air Transport Association Director General has been speaking at a briefing, Willie Walsh, and he was talking about how domestic traffic is down 51%, at least in February, and that going forward from May through September, you're still going to see traffic down substantially, although picking up. And Tom, this to me is one of the key questions, the bifurcation between domestic travel in places like the U.S. and China, where inoculations are going a little bit better than planned, or Europe, or internationally, still down dramatically, like 89% year over year based on 2019 levels.
Ed Bastian at Delta's been dead on in this. He was heated in his comments to David Weston a week ago, or 10 days ago, I should say, saying that domestics there and international really waits out well into 2022. On these dynamics, James Sweeney joins us with Credit Suisse and their chief economist. James, I want to get to the inflation discussion, which you are expert at, but let us first look at the body count discussion. Delta Airlines said the other day they're having trouble getting employees. Things are ramping up so fast. How close are we to a tight labor market in America?
Well, we're close to a labor market where firms are racing to hire more workers that they can in a short period, and that's likely to put some upward pressure on wages. That's not the same thing as a equilibrium labor market that's tight, right? It's not a low unemployment rate, but we're going to see wage pressure with high unemployment for a little while because firms are going to need to get these people back quick because vaccinations are happening, social distancing is going away,
right,
and checks in the mail.
So your claim, James Sweeney, is you put the inflationistas in the timeout chair 2-3 years ago as well. How are those inflationistas doing right now? Do you agree with them? We've got something to worry about?
I think there's a discussion to be had at least. I think they're a little excited at the moment, the inflationistas, and I think the question really is temporary or not. It's not, are we going to see some increases in prices? We definitely are. But the Fed is saying, oh, we're going to temporarily see inflation rise, but then we'll be fine. Well, that's okay. But if you're in financial markets, it kind of matters how far inflation goes in the next 12 to 18 months. And it's going to roil bond markets and equity markets. And of course, those inflationistas, if they see 2.5%, 3% inflation for a little while, they're going to get all excited and they're going to extrapolate that deep into the future. And we're going to have an interesting market moment. So the Fed makes a lot of sense when they say it's temporary. But I think understanding what it's going to be like as we go through this is going to be very important.
James, I buy that oil prices increasing or decreasing could be temporary. Copper, it's the same kind of thing with a bunch of different commodities. Wages, there's a different dynamic. How frequently have we seen wages go up and then subsequently come down because they say this was transitory? Just kidding.
Well, it's wage growth coming up and then coming down. It's not wages actually falling. And I think before the pandemic, there was some evidence that the kind of lower wage part of the labor market in the services sector was seeing a little more tightness. You were seeing somewhat faster wage growth in sectors like retail and leisure and hospitality in the years before the pandemic than you had seen in 15 or 20 years. There's something structurally tightening up the labor market. Then you have the pandemic and everything's very loose again. Then you have vaccines, reduced distancing, lots of stimulus at the same time. Everyone wants to go on vacation. Firms need to scramble to get back their workers. These workers have a little bit of bargaining power at the moment. And so wage growth is going to be, I think, accelerating for some workers for a little while. Whether that's sustained and whether that turns into persistently higher price inflation over many years is a very different thing and something we shouldn't necessarily jump to. But again, how much wage growth are we going to see? How much inflation are we going to see in the next 12 to 18 months is a critical question for financial markets, yields, monetary policy. All these things.
And a big aspect that's fueling some of these inflationary concerns or excitement, whatever you want to put on that, currently is this infrastructure spending plan, is the fiscal package that was passed earlier this year. People talking about the potential downside for higher corporate taxes, higher taxes on the wealthy individuals. Based on your economic history, on your economic studies, what credence is there? How much would higher taxes crimp growth?
Well, I mean, post-tax earnings expectations, particularly in certain sectors, are going to come down as statutory tax rates go up, and particularly if they find a way to make this global minimum tax bind on some firms that are paying, much less than statutory rates. That's a stock market issue. So that's a little bit of a negative for the equities of specific firms that are going to take that hit. From a GDP perspective, I don't think we're going to have so much infrastructure spending from the infrastructure bill that we haven't passed yet this year that we're going to have a huge surge in growth. But you're looking at more infrastructure spending, more demand in the economy in 22, 23, 24. So it's a brighter growth outlook. It's a slightly weaker outlook for earnings. And business investment overall in shorter periods is not very correlated with what happens in taxes. Tax changes historically explain a very small share in the variation of business investment in the short term.
Do you see or can you predict business investment?
That's a tough one. Business investment historically is one of the most volatile parts of GDP. And the errors tend to be very large. When they make fun of economists and say you get GDP wrong, it's usually business investment doing the work there. Right now, though, interest rates are low. A lot of firms haven't invested for a while. A pent-up need to invest is probably the easiest easiest reason to expect stronger investment. And I do expect business investment to pick up over the next year. You got to look at sectors, where will oil prices be? How will that affect structured spending and mining, energy mining, and things like that? But the business investment outlook is pretty bright, and I don't expect these higher taxes to get in the way.
James, just to wrap up, what's your highest conviction idea about this year that perhaps goes against consensus?
Well, I think the consensus has an inflation expectation of around 2.4% for this year. I think that's a reasonable view, but I think you have to throw out those point forecasts right now and look at a distribution of inflation risks. And I think that the tail to the upside is fat and long. And so there are risks that short-term inflation is significantly higher than that in the period from this summer until next summer, late 22. Again, that's not necessarily long-term persistent inflation, but that's something that investors need to think about. That's something that could trigger the Fed to hike earlier than they're saying now. And so I think focusing on that distribution and not the point forecast is what's key.
James Sweeney, thank you so much. With Credit Suisse, their chief economist. At least I really can't convey enough the mystery here on inflation. Not only that, but the separation and the partition of inflation out to service sector and goods. Do we get back to goods, disinflation, or deflation? That's a further mystery way out into 2022.
And complicating it all is that the areas that have seen inflation during the pandemic have been discrete, right? The idea that we go to the grocery store more, that we buy more things to put in our homes, we don't go out to do things with our friends, and services, which traditionally had been where a lot more money was going, have not been able to sort of fulfill that service, that sort of purpose. It raises a question of how we even measure inflation at this time, because when you go to the grocery store, the prices are getting a lot more expensive. I mean, you get a whole paycheck and you get, dog biscuits for a vet bill, and they cost what, $10 each?
We're buying the dog biscuits for afterthought, but that's a different story.
Please do go on.
Yeah, food has gone up, to say the least. We'll have to see. And again, I would fold it back into real estate, both the direct cost of real estate and the implied cost of real estate, which you'll see in some of those statistics. Mr. McKee, a little more expert at that than I am. Futures at -5, Dow futures -43. Lisa, as bond yields have driven lower, price up, yield down, high yields done the same thing through 3% on the spread, right?
2.93 percentage points over benchmark yields. That is what we're looking at in terms of what investors are demanding to own high yield bonds. Right now, just give you this statistic. High yield bonds are yielding the least versus investment grade notes going back to 2007. That spread compressing. People going into risk.
Is that a frenzy of buying?
It's a frenzy of buying and the riskier credit because people are not worried about defaults. They're saying these companies are not going to fail to pay their bills. They've pushed out their debt maturity.
Okay, guys, if you're planning to trade Swiss franc, I'm placing a new order to buy Swiss franc at 0.92915. Okay, I'm placing an order to buy Swiss franc at 0.92915. So if you're looking to trade this, please enter this position right now. Please enter order, and I'll let you know what's going to happen next.
To help pay for it, still, Amazon CEO Jeff Bezos stopped short of endorsing President Biden's $2.2 trillion infrastructure plan. In a statement, Bezos said the investment will require risk concessions from all sides. The U.S. says it will consult with allies about how to handle the 2022 Winter Olympics in Beijing. That sparked discussion of a possible boycott over China's human rights record. Last year, more than 160 human rights groups urged the International Olympic Committee to hold the Beijing Games elsewhere. France's finance minister wants to know what happened with the European Union's recovery fund. He discussed the slow rollout of the fund in an exclusive interview with Bloomberg TV.
But the point which is not on the right track is the European recovery plan. We have not seen one single penny among the 750 billion euros that have been decided last summer in 2020. I'm deeply concerned by the delay in the implementation of the European recovery plan. That's the key point.
Money from the EU fund isn't scheduled to be handed out until at least June. JP Morgan CEO Jamie Dimon built the most profitable bank in U.S. history. Now he's warning that the industry's disruption by technology is at hand. In his annual letter to shareholders, Dimon says that, quote, fintech and big tech are here big time. He writes that traditional banks now have a shrinking role in the financial system. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Has the balance of risk actually shifted since the last policy meeting?
Well, our balance of risk is still tilted to the downside in the short term, but it is much more balanced in the medium term.
What are markets exactly buying at the moment? They seem to be continuing testing central banks.
They can test us as much as they want. We have a mandate, we have an aim, we're going to be riveted to that, and we're going to do what is required.
Model minority myth wasn't something that was fabricated by the Asian Americans. It was created as a tool to alienate the Black and the Asian American communities, and it was incredibly successful.
We know that racism didn't begin yesterday. We know it's probably not going to end tomorrow, but it is our job to make sure that there's progress and we keep people safe, people dignity.
I spent a lot of time last year to just listen, to understand, to reflect, and understand what I could do as a leader of this organization.
For many years, we've been very shareholder focused, and now there really is much more of a community requirement.
The economic downturn in the US, we're seeing unemployment and income losses affecting women more than men.
2/3 of the jobs lost in South Africa were women's jobs. So I think we're in a moment of crisis.
Clearly, our societies are reproducing, not reducing inequality.
We need better public policy and we need companies to step up.
Okay, guys, this is what I'm going to do next. Because I've got two short positions, I need to reduce one position because we have long position at quite higher level. What I'm going to do, I'm going to place stop on profit at 137.75.4. This way, I will keep my short position as the hedge position for my long position, and I will end up in profit if it will, probably right now, when it will change direction. British pound, when British pound will change its direction, okay? So I placed order to sell short. I still hold short position at 138.240, okay? And we still hold position. Okay, position closed on British pound at 137.754. We have 200 pounds in profit on this position. On Swiss francs, as you can see, it's moved up really rapidly, so I will have to cancel this order. So if you want to trade Swiss franc, please trade it or wait until I will let you know and cancel your order right now to buy Swiss franc, okay? But in this case, we have profit on British pound. Okay, well done, guys. All of you who followed my trades for several weeks or who purchased the strategy and decided to follow trades, you're doing really well. Well done. Not many, believe me, not many day traders can trade the way you do, because you can trade both ways. And if you hold a strategy, you know how to do this. If you don't hold a strategy, if you want to find out how to do this, you need to get the strategy from our website or from our streamer. So company.co.uk, or you can check on streamer and you'll get the strategy. You'll find all information over there. Stay safe.
What was the switch that got him going?
He decided to turn his life around and became a Rhodes Scholar at Johns Hopkins, went to Oxford, got a degree at Oxford, and then decided to give his time to the military, and he went to Afghanistan as a officer there, served in several years in Afghanistan, came back and got involved with a number of other activities, but now for the last 4 years been running Robinhood, and he will until the end of May, and then he was planning to run for governor of Maryland.
I mean, this is absolutely extraordinary, folks. To all of you on radio and television, this is the kid that turned it around and made good of it. What has he done at Robinhood, the foundation? Let's be clear, David. I believe Robinhood every year gives all the money away. It's a true conduit for charity.
Yes, the financial community basically puts up all the money for the administrative costs. All the donations, 100% of them are given away every year. It's about $400 or $500 million a year, and this is going to largely deal with the poverty problems in New York City and the environs around New York City, and it has been replicated in other parts of the country as well. And Robinhood has been I'd say the signature type of anti-poverty action that the financial community can claim a good deal of credit for helping to get started.
Is Westmore electable?
No African American has been elected statewide in Maryland, other than as lieutenant governor on a governor's ticket. So, you know, Maryland is a Democratic state, has a large black population. Obviously, he would appeal to more than blacks, but he's a Democrat, and there are a lot of people seeking the nomination. So too early to say. He's never run for office before, but he was certainly a strong, articulate candidate. No doubt about that.
James Dimon today, David Rubenstein. I'd love to see a David Rubenstein 66-page annual letter. That would be great, David. Mr. Dimon out with a letter, and he talks about fortitude as being part of leadership. What is the fortitude you've observed from Westmore?
Well, he's overcome some real disadvantages in life. He was handcuffed by police when he was 11 or 12, sent to a military academy, had some real challenges as a youth, but then turned it around at Johns Hopkins and went on to Rhodes Scholarship. And now at the age of 43, I think he has a pretty promising political career ahead of him if he wants to pursue that, and I think he will.
David Rubenstein, on this day where Mr. Dimon writes his annual letter, there's been lots of discussion about Jamie Dimon as appointed or elected political official. Can CEOs like James Dimon become politicians in this modern America?
It's tough because now everything you've ever done over 20 years or so is looked at, every business deal, every transaction. So it's more complicated to do that as an elected official. Maybe as an appointed official, it might be a little bit easier.
What do you see, David, right now on travel? The other great theme we see, and Mr. Dimon was talking about this, the opening up of America, the international economy, much delayed as well. What does Carlyle observe in the opening up of America as we end this pandemic?
Well, let me just give you my own observations.
Please.
My observations are that people want to go back to their office, maybe not 5 days a week. People want to go back and travel, maybe not as much as before. I think vacation travel and leisure travel will come back ahead of business travel. Business travel will come back, but probably not at the pace that it once was, where you would fly around the world for a half-hour meeting. I think that probably can be done through Zoom or the equivalent. But I do think people have a pent-up desire to go back and meet with other people and see the rest of the world they haven't seen for the last year or so.
What is the character of higher yields that you see? I mean, not so much, the narrowness of internal rates of return on a transaction or a combination, but what do higher yields do to the mindset of CEOs and C-class officers?
Well, higher yields, obviously make people a little bit nervous because it means that, inflation might be around the corner, and we haven't had serious inflation for quite a while. People are worried about modest inflation relative to what we had in the 1970s. I do think the U.S. economy is in pretty good shape because of the stimulus we've had. with the enormous amount of stimulus we've had, it's difficult for the U.S. economy not to grow at 5 or 6% this year, and I suspect next year will be in pretty good shape as well. Who can predict 2 or 3 years down the road? We'll probably have some inflation, but I don't think it's going to be inflation that's going to be anything close to what we've seen in the 70s.
David Rubenstein, thank you so much. Greatly appreciate it. And congratulations on a spirited original interview with Wes Moore of Robinhood, the charity. Wes Moore, really a unique person. Look for that tonight. Peer-to-peer conversations, 9 p.m. This evening. I do want to point out the trade balance right now, because it is a pandemic vector of immense distress. It has been linear over the last number of years and very negative. Let's call it a negative 50 statistic. And then with the gyrations of the pandemic and all, maybe it was negative 40. And it has been not a plunge, but it is a straight line down to a shocking negative 71.1. I don't have in front of me the twin deficit nature of this for America, but nevertheless, there it is. The distortions of trade and capital flows are tangible in this pandemic and in this new divergence that we see. That is on radio. I can only tell you it has been a managed negative chart. Of course, President Trump talking about his distrust of a deficit. But boy, do we have a new, ever larger distinction here between our exports going out and our massive imports with the American boom economy now coming in. This will be a source of conversation with Kristalina Georgieva today of the IMF. I really can't say enough about this interview. I believe I've interviewed her 2, 3, 4 times before, but this is a time of immense, not a tipping point, but a point of divergence for the International Monetary Fund and their representation of the developed nations, including China, and their assistance with the World Bank to the less advantaged countries like Brazil and like India, where we see some real pandemic challenges. Look for that, I believe, at 11:30 this morning. Futures -7, Dow futures -54, a very quiet screen. I can tell that on the Bloomberg terminal with the blinking of the red and the green. Stay with us through the morning on Bloomberg Radio and Bloomberg Television.
BSO Now is your online home for brand new Boston Symphony Orchestra and Boston Pops performances. Discover new releases each week that include behind-the-scenes storytelling with conductors including music director Andres Nelsons, guest composers and musicians, plus critically acclaimed archival concerts and more. Visit bso.org/now, where the music plays on. BSO season sponsored by Bank of America.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
I have asked the Securities and Futures Commission and the Hong Kong EX to work together to explore the viability of our own Hong Kong version of SPACs. We remain very confident on the competitiveness of the Hong Kong stock market.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar. From New York City for our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. The countdown to the open starts right now. We begin with the big issue, a market resting in the hands of the Fed.
All the rhetoric coming out of the Fed.
It's going to be a hotter cycle.
The rate hikes are still not a base case.
The Fed, I don't believe, is changing anytime soon.
The market's making new highs in the meantime.
The low rate environment has fueled a lot of this fire.
Monetary policy has just been so accommodative.
There is still so much liquidity in the market. That has played a big role.
We're going to get some fascinating information later today.
I'm not sure power will flinch this time around.
The biggest fear on every investor's mind right now.
What if there's an inflation overshoot?
Inflation big enough to force the Fed's hand in raising rates.
This is a new Fed. They have a new paradigm.
They are going to allow the economy to run hotter.
Markets are going to be wrestling with policy change.
Central banks are still perceived to be such an important factor in the evaluations of all financial markets.
Heading in to, of course, we're going to get the meeting minutes in at 2 p.m. today, New York time. For more, let's bring in the Bloomberg team, Michael McKee and Kaylee Lyons. Mike, what are we expecting to hear with the FOMC meeting minutes today?
Well, probably not as much as people would like to hear if they think the Fed is all that important to the markets. Wall Street doesn't employ Fed watchers anymore to parse the markets and figure out what policy is. We know what it is because they tell us for years in advance. Now, the dot plot did show a bit of a change at the last meeting, from one member seeing a rate increase in 2022 to 4, and from 5 members seeing a move in 2023 to 7. How certain were those more hawkish dotters? Can we read real concern about inflation into anything they said? That's something you can look for in the minutes today. The balance sheet's another question. We're almost at $8 trillion. Forecasts are we'll be close to 9 by the end of the year. How big do they think it can go? And are there any hints about taper timing? That's going to be a real preoccupation for many people in the markets today. More maybe on the regulatory front, any staff or policymaker discussion of the leverage ratio for banks is also something you could look for. The problem, of course, is even if there is the bare hint of something, all of this comes from a meeting that was 3 weeks ago. We have more data now. We have more people vaccinated now. We also have more COVID cases right now. How much of what we thought then and what they thought then will apply today? We also have the latest round of checks from the government coming into the economy over the past month, and we have some data on how they're being spent. The New York Fed studied what people are doing with the money, and as time goes on, as you can see, a smaller share being spent than back in June after the first round of checks. Less is going to paying bills and more towards savings, leaving us to one other thing to watch for today, discussions about how big a spending surge we might see from the fiscal side. Lisa?
Michael McKee, thank you so much. Meanwhile, there's a weight to the tape. Equity markets have been, though, enjoying the combination of strengthening economic data and contained bond yields. Bloomberg's Kaylee Lyons joins joining us with more. Kaylee.
Well, yeah, Lisa, riddle me this. We get upside surprise after upside surprise on the economic data, both ISM manufacturing and services, strong payrolls on Friday, and the City Economic Surprise Index is trending upward right now, showing more than half of all data points are beating estimates. You would think that better data means better growth, more inflation, more growth and inflation leads to higher bond yields, and that hasn't really panned out over the last week. Over just the last 3 days, the 5-year nominal yield has fallen from nearly 1% to just around 87 basis points today. And when you look at break-even rates, which gauges market expectations for inflation, they've basically gone sideways too. Of course, there are several factors that could be at play in that phenomenon, Lisa, including the possibility that bond investors just see enough growth priced in already. But the other factor we have to consider here is the almighty Fed, because the Fed is still active in the market, providing abundant liquidity with the massive expansion of its balance sheet. And if policymakers keep reiterating dovish messages the market has faced in that dovish Fed, that could keep yields steady. And that is a good thing for equity investors, because that means you are still getting the better growth outlook, the better growth picture, but not the higher borrowing costs that come with it. That would be like a Goldilocks scenario, the kind of which JP Morgan CEO Jamie Dimon talked about in his letter today. But again, the Fed is the big question mark in that equation, Lisa.
Kaylee Lyons, thank you so much. Or if Jamie Dimon is correct, perhaps the bond market is just wrong. He released his letter today, to his annual letter to shareholders, saying he's optimistic about the U.S. recovery, and it could even run into 2023. He writes the following, quote, "I have little doubt that with excess savings, new stimulus savings, huge deficit spending, more QE, a new potential infrastructure bill, a successful vaccine, and euphoria around the end of the pandemic, the U.S. economy will likely boom." Joining us now to discuss is BlackRock's Tony DeSpirito. Tony, this certainly is consensus that we were headed into a boom, and certainly that list of potential catalysts is long and growing. How big is it going to be? Are we adequately pricing in how big the economic surge will be in the United States?
Well, Lisa, it's going to be big. And we're living in an unprecedented economy. That was true on the downside, and that's going to be true on the upside. This is going to be a recovery like something we haven't seen literally in a generation. The factors driving the recovery are numerous. We have fiscal policy that is off the charts, right? Stronger than any time since World War II. We have strong monetary policy. They're both big and coordinated, and they're not just in the U.S., but they're global. So that's big. Obviously, the vaccine and the pent-up desire to return back to normal, particularly in terms of consumer spending on services. And then you look at consumer balance sheets. Consumer balance sheets are way better than they've ever been in any other economic recovery, meaning consumer savings actually went up during the pandemic. Home prices went up, net worth went up. And so consumers both have the confidence and the ability to spend. And so I think we're going to see GDP numbers that are really blow out this year, 6, 7, 8%, maybe on a real basis. And then that's going to translate to earnings, because in the early stages of an economic recovery, we usually see great operating leverage as companies hold the line on costs and yet get the incremental revenue. And so we see margin expansion typically. And so I think we're going to see really strong earnings this year. And that's why you're seeing such a strong stock market, quite honestly.
And this has been the consensus idea throughout 2021, with a lot of people talking about this rotation into cyclical stocks, into consumer discretionaries. And yet there was a recent survey done by Bank of America that showed that hedge funds have actually shied away from going full on into the reflation trade. They're actually sticking with more of the haven type stocks. Can you explain the thinking behind a trade like that? Does it just not make sense at this point in a credit cycle or an equity cycle?
Well, we've been saying since October that we're going to see a strong rally in cyclical value stocks. And certainly since the announcement of the Pfizer vaccine back in November, that's what we've seen. And the fact that hedge funds have been hesitant to get on the trade just tells me that there's more room for the trade to go, that there's still money on the sidelines that hasn't plowed into the trade yet. And so therefore, the trade continues to have legs. And by the way, that's right in line with history. We've studied all the recessions going back 40 years, and every recovery, every single one of those recoveries, cyclical value stocks have outperformed over the next 24 months. So I think this cycle is right in line with prior ones in that sense.
Next week, we're going to start getting some of the bank earnings, and this follows the letter that we got from Jamie Dimon today, where he was talking about his expectations for higher benchmark yields in the United States. He said this before. He hasn't always been correct. However, he has a lot of company this time around. Do you see financials as a key area of growth, both in terms of on their fundamental level as well as the equity valuation?
I do. So in the fund I run, the equity dividend fund at BlackRock, we are overweight financials. And here's why. One, a strong economy is good for banks. We're seeing it in terms of sales and trading and investment banking. We're seeing it in terms of credit quality. Banks are likely to be releasing reserves over the coming 12 months. We also see it in terms of their ability to return capital back to shareholders. They're overcapitalized, and the Fed's now going to let them buy back more stock starting in the second quarter, and we'll even start seeing dividend hikes again. And then finally, when you look at the valuations are, even with this run, are still pretty attractive. And they also provide, if you're worried about inflation, they also provide great upside in a more inflationary environment. And so that's a free option on inflation, in my view.
Tony, when you talk about financials, is it the big U.S. banks? Is it the J.P. Morgans, Morgan Stanley, and Citigroups of the world? Or are you starting to go into, say, European banks, Japanese banks, other areas of the world?
Yeah, so we really focus on quality and stability, and I think that's where the U.S. banks really lead. Our regulatory structure and our capital structure of our banks is way safer and sounder than the rest of the world, and we saw that. We saw the importance of that during the pandemic, whereas in Europe, banks had to stop paying dividends. In the U.S., they were able to continue to pay their dividends even throughout the crisis. And so I think the greater capital balance, the greater resiliency of U.S. banks is really important. And so we still favor the U.S. banks over the non-U.S. And then within the U.S., we favor the money centers. They have a more diversified earning stream. They have better capital ratios. And so we still prefer those over the more regional, smaller banks.
Tony DeSpirito is sticking with us. We'll continue the conversation about the nexus between yields and stocks. Right now, Bloomberg's Abigail Doolittle joining us with a look at the stocks moving ahead of the opening bell. Abigail.
Good morning, Lisa. Well, the futures may be down slightly, but that reopening trade continues to some degree with the cruise line operators. These stocks are higher, and of course, Carnival reported this morning. Now, the quarter they just reported really doesn't matter. It's going to be all about bookings trends. Their call starts at 10 a.m., so all eyes there. But you see all of these cruise lines trading higher. The optimism continues, as yesterday the CDC said that cruise lines may be in the water, may be possible from a health perspective midsummer. And of course, Norwegian is aiming for a July 4th setting sail on the water July 4th, and then later in July for both Europe and the Caribbean. So lots of green on that screen. Also the case for some of the names right at the center of that Archegos blow up. Take a look at Viacom, up 2.6%, getting a raise over at Wolf to outperform. Discovery also higher as Deutsche Bank has raised its price target. So investors looking right past all of the drama, Lisa, and going in for what maybe some perceive as a bargain after that roller coaster ride.
Abigail Doolittle, thank you so much. Coming up, we'll have a conversation. President Biden gearing up to pitch his American Jobs Plan for a second time this week. That conversation coming up next with BlackRock's Tony DeSpirito and John Hurdle of Hurdle and Callahan. Right now, we're seeing a weight to the tape with futures at the lows of the session ahead of the open here in about 20 minutes. Meanwhile, yields lower as people assess how far they have gone in the past couple of weeks. This is Bloomberg.
Julie Chang explores how a chip shortage snarled everything from phones to cars on a Bloomberg television special, Chip Crunch, Wednesday on Bloomberg Technology.
Yesterday, we crossed 150 million shots in 75 days, the first 75 days of my administration, on our way to hitting our goal of 200 million shots by the 100th day in office. That, of course, is the new goal I set after passing the original mark of 100 million shots in my first 100 days, doing that in just 58 days.
President Biden touting the success of his vaccine, saying he wants all Americans to be eligible for a shot by April 19. Up next is his agenda on a speech from White House this afternoon to sell his American Jobs Plan. Bloomberg Chief Washington Correspondent Kevin Cirilli joining us with more. What are we expecting to hear from President Biden today, Kevin?
Salesman in chief, and already the reaction from the private sector is beginning to trickle in, including from Jeff Bezos of Amazon. Let's take a look at what he said. Quote, "We support the Biden administration's focus on making bold investments in infrastructure. Both Democrats and Republicans have supported infrastructure in the past, and it's the right time to work together to make this happen." Meanwhile, up on Capitol Hill, President Biden is going to have to win over some support for how to pay for this $2.25 trillion infrastructure proposal from his own party, including from Senator Joe Manchin, the centrist Democrat from West Virginia, who has expressed now publicly in local West Virginia interviews that he is apprehensive about raising the corporate tax rate to 28% from its current level of 21%. He's expressed some interest at raising it to 24%, but reportedly Transportation Secretary Pete Buttigieg, whom President Biden has assigned to help usher through this proposal, is going to be speaking with Senator Manchin, and that's something that's on my radar for the next coming days.
Kevin Cirilli, thank you so much. In the markets, you're not necessarily seeing big tax increases getting priced in, and this is a big conundrum for a lot of market participants. TD Securities' Priya Misra weighing in just on that, saying, quote, "All eyes are on the fiscal negotiations. The proposal has huge tax increases, but if they get watered down, rates will rise." Joining us now, John Hurdle of Hurdle Callahan, and still with us, Tony Zaspirito of BlackRock. And just wanted to start with you, John, this idea of the market implications of tax rate hikes. Are we seeing them at all? Is anyone counting on these to come to fruition?
Really, first of all, good morning, Lisa. It's nice to see you. I think that what we're seeing is that the tax hikes are not significant enough in the future to offset the optimism that is against earnings and the rest of the environment, where you have this race between earnings and interest rates, and earnings are winning right now. So yes, it's a concern. This is, it's all about going forward with earnings, but the earnings look so strong right now that the potential corporate tax increase doesn't seem to diminish everyone's enthusiasm.
Tony, would you agree with that, or do you think that people just are counting on these tax rate hikes to not necessarily get passed?
No, I do agree. I think people are looking at the earnings growth, and the earnings growth is just going to be extraordinary. And so that's kind of overwhelming everything right now. I do think there's an opportunity as a stock picker, however, which we are doing, to really try to say overweight some of the companies that will be less hurt by a tax increase, and then underweight those that might be more hurt. So I do think there's an opportunity for stock selection within there.
Can you give examples of sectors that may be more hit or less hit from these tax increases that you're looking at?
Yeah, and I think you have to look in the non-obvious places, actually. So it's less about sectors and more about individual companies. If you look at the details of the proposal, it's less about the hike in the tax rate from 21 to 28 or whatever it ends up being, and more about how international earnings are treated, right? There's I'll call it a minimum global tax rate that's in the proposition. Also, the GILTI tax, right? And those are how foreign operations are treated. And I think companies that have been really taking advantage of those loopholes those are the ones that are most at risk. And that's much more of an individual company situation than it is a sector situation per se.
And John, on the other hand of this whole debate is the infrastructure spending, the idea of true investment in the United States. How much are we pricing in that type of impulse in specific companies that could benefit? Or is there a lot more room to run should this become a more concrete plan with more feasible way to get passed?
Well, first of all, I think if you look at the infrastructure bill, the way it's proposed today, maybe, I think if you're kind, maybe a third of the $3 trillion is actually infrastructure. So when we have the political process go through, you know, who knows what's going to happen? And it's going to be spread over many years. But we all know we need more spending on infrastructure, roads and bridges and so forth. So I think we've been crying. There's been a lot of people asking for that for decades. So in one regard, it's good news if we can figure out how to pay for it, if it's reasonable and so forth. So this is another opportunity for progress. And I hope the political process will generate something that actually focuses on infrastructure.
But hope isn't really an investment strategy. I mean, are people actually starting to price this in? Or is it basically considered a pipe dream?
In other words, it's going to, what you have right now is this tremendous rebound in economic activity that's kind of overshadowing everything else. And one of the reasons that, you know, people in Washington are eager to get their piece of the pie here is because they see how strong the rebound is. So the political process, what we hope will happen, and I agree with you that hope is not a strategy, that's for sure. But, you know, on average, over time, this works fairly well. So if we can make that bill more focused and we can have better roads and bridges and tunnels, that's going to be a good thing. So we just have to let it work its way through the system and see how it comes out. But right now, going back to this race between earnings and interest rates, like for example, if you think that's too much money to spend in a short period of time, that'll impact interest rates. Conversely, if you have this notion of corporate taxes, that's going to impact earnings. So we have this tension right now between earnings and interest rates, and so far, earnings are winning.
All right, Tony, at what level do interest rates start to bite? In other words, we're dealing with this dynamism that we're talking about, incredible earnings growth, incredible hiring that we've seen in recent reports. At what point do yields rise above the point of no return where you have to start questioning the valuations of some of those popular equities?
And I really like the way you framed the question, at what point, right? Because we can look back to November since the Pfizer vaccine announcement and see that we've been in a period of rising economic and earnings expectations, rising rates, and yet the market has gone up. And so we can definitely see rates rise and the market go up at the same time. So I don't think that's the issue. The issue is at what point, as you put it, do rates become problematic? And when we look at our models, our dividend discount model on the equity market, I would say the equity market really never bought into the idea of the permanency of low rates, meaning the equity risk in this low interest rate period since the global financial crisis, really, the equity risk premium has been extraordinarily high, meaning in some sense the markets have already been pricing in higher rates. Based on the calculations I've done, I'd say that's in the 3 to 3.5% range before you have to really worry about it impacting the market as a whole. So I still think there's a lot of room to run on that score.
And quickly, I just want to get from both of you, we got some earnings out of Carnival, and actually it was disappointing. First quarter adjusted earnings, actually net loss, I should say, exceeded estimates of $1.95 billion versus the estimate of $1.74 billion in losses. What happens if earnings disappoint? How big of a correction could there be? John, last word.
It's all about earnings, you know, and we're looking forward. And I don't think that one data point really is going to matter. And I know we're looking through the valley here. We've been looking through the valley for a long time. You know, as a chief investment officer, I'm really worried about returns over the next 5 and 10 years. And so I don't think that particular data point is going to matter. But if we see earnings disappointments broadly, which we do not expect, that will certainly impact this tension between interest rates and earnings.
Tony DeSpirito, John Hurdle, thank you both so much for being with us. Coming up, the analyst action you need to know, that's next in our morning calls. Then later, we'll talk about those cruise stocks, of course, and we'll also talk about what is rallying and what is not today with BNY's Alicia Levine and Invesco's Rob Waldner. From New York, we're seeing a wait to the tape. This is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Wells Fargo upgrading Fox to equal weight with a $41 price target. The analyst expecting to see a big boost from its recent rights deal with the NFL. Next up, Wolfe Research upgrading Viacom CBS to outperform with a $70 price target. The analyst citing an appealing valuation following the stock's recent sell-off. And finally, Barclays raising its price target on Square up to $330 with an overweight rating. The analyst seeing meaningful upside to international earnings estimates. Coming up, cruise stocks, they were rallying. Carnival did announce it had enough liquidity to resume full operations, but it also did post a bigger loss than expected. The future of travel, the future of leisure, that conversation coming up next in tandem with the reflation trade with Bank of New York's Alicia Levine and Invesco's Rob Waldner. Meanwhile, you're seeing a bit of a wait to the tape, but basically a churn. Not a lot of activity. Yesterday was a very calm day. From New York, this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Farrow. This is Bloomberg Real Yield.
Good morning. We are just moments away from the opening bell here as we await the open of a calm week with a lot of people on vacation. You can see the weight to the tape has lifted a little bit, trying to get to flat as we hear the opening bell right there. Russell 2000 basically